Okay, good morning, ladies and gentlemen. Maybe I could have a thumbs up if you can hear me. Welcome to this morning's CLE training. My name is Jonathan Chuana. We should be starting in the next 1 or so minutes. Thank you. I've got a thumbs up, so I confirm that everyone can hear me. My name is Jonathan Chuana. I'm a senior associate with AF Mpanga Advocates with about 10 years experience. And this morning, our training webinar will be on mergers and acquisitions, demystifying mergers and acquisitions. We have an excellent panel this morning of Mrs. Gertrude Wamala Karugaba, Mr. Naval Sood, and Mr. Moses Segal. I'll just begin the recording. I hope we'll have no problem with that. Yes, so I'll just introduce our panel briefly, and then we'll have a few remarks from a council member, the ULS council member, and then we'll get started with our presentation. So Mrs. Gertrude Wamala Karugaba is an accomplished business executive and legal and governance professional with over 20 years experience in financial services, corporate law, and board leadership across East and Central Africa. She currently serves as a Group Chief Legal Officer at Equity Group Holdings PLC, the largest financial services group in East and Central Africa, where she provides legal and strategic leadership across banking, insurance, fintech, and social impact subsidiaries operating in over 6 countries, including M&A activities. Mrs. Karugaba is a dual qualified commercial lawyer and an advocate of the High Court of Uganda and of Kenya. She's a Commissioner of Oaths and Notary Public. She holds a Master of Laws degree from the University of Cambridge, where she was a Cambridge DFID scholar, and a Bachelor of Laws degree from Makerere University. She has completed business and law professional trainings in various institutions around the world, including the Law Development Center and the Cambridge DFID. The Law Development Center, where she received the Chief Justice Award for Academic Excellence. She holds senior leadership positions both in the private sector and the financial sector. Formerly, she was a partner with DLA Piper Africa and head of legal at Stanbic Bank. She has served as transaction advisor on several landmark and capital markets deals in the banking sector. So we have with us, an accomplished speaker there, Naval Sood. Mr. Naval Sood is an accomplished transaction advisor, although disclaimer, he's not a lawyer, but as you will hear soon, he's as good as, probably better than many lawyers in the field. He's a transaction advisor and expert in the field of mergers and acquisitions, who has spent over 40 years helping clients, do complex M&A transactions, privatization deals, capital market transactions in East Africa and the broader Sub-Saharan Africa region. Currently, he's the director and shareholder of a boutique M&A advisory firm that he founded 3 years ago, after a long career as an investment banker and transaction advisor. He specializes in financial sector transactions and has helped several regional and financial services groups grow through acquisitions and attracting new equity investors. Naval is an accountant by profession and started his career with Deloitte in the audit department in 1980 and led audit teams for some of the major financial service institutions at the time. He then left study for an MBA in London Business School in 1988, and on his return to Kenya in 1990, he joined PwC, where he helped set up PwC's corporate finance team. In the 1990s and early 2000s, he spent much of his time helping governments complete privatization projects, including that of Zanaco in Zambia and Kengen in Kenya, and the pre-privatization split of National Bank of Commerce in Tanzania. After the privatization market dried up, he moved to advising private sector clients, complete M&A transactions, including advising Equity Bank on the investment from Helios and its purchase of Uganda Microfinance Bank. Naval left PwC to join Stanbic Bank in 2010 and led its regional M&A team. He helped complete some of the largest and most complex assignments in East Africa in that period, including the Umeme IPO in Uganda and Ruby's takeover of Keno Kobil, and the sale of Jubilee's general insurance business, including its Uganda subsidiary, to Allianz. I think that's the latest big transaction. He also advised Equity Group on its acquisition of BCDC Congo and Congo Bank in Rwanda, and the sale of BPR in Rwanda to Atlas Mara. And Val, we are happy to hear from you and hear and drink of your wisdom this morning. And lastly, the last person, but by far not the least, is Mr. Moses Segawa, who is a partner at S&L Advocates, where he heads the employment and pensions practice. He's a highly regarded employment law expert and regulatory advising on regulatory compliance, corporate restructurings, transfer employment, and undertaking, among others. Moses advises a variety of clients, including leading multinational corporations, public sector enterprises, and development organizations. He has consistently been ranked by Chambers Global as a trusted expert on Uganda's labor law landscape. So members, as you can hear, we have a great panel this morning of experts in their different fields, and I'm sure we're going to learn a lot. But before we go any further, we'll just hear a few remarks, opening remarks from a member of the ULS Council, and then we'll get into our discussion this morning. Over to the ULS panel, Council member, sorry. Okay.
He's logging in shortly.
Okay. We'll just give him a minute to move in. Okay, we'll just give him a minute or so, and then we'll kick off.
You most welcome, Mr. Vice President.
Okay, we'll hear from the Vice President and get started. Good morning, Mr. Vice President. Pleasure to have you.
Morning, a pleasure to have you too. Sorry, members, was on the road. I had to, in fact, headed for the bar bench at Supreme Court, where I have to represent the membership. But nonetheless, appreciate this. Our esteemed facilitators, Mr. Naval Sud, Ms. Gertrude Wamala, and Mr. Segawa Moses, Mr. Jonathan Chiwana, members of the bar, ladies and gentlemen, a good morning to you all. I bring you some greetings from the president of the Radical New Bar, the governing council, and the entire secretariat. For me, it's a real pleasure to have you all join us for this virtual session. We've put together a very practical and informative program that looks at the M&A landscape, the legal and regulatory framework, key stages of the deal process, employment law considerations, and what the future of M&A practice might look like especially from a lawyer's point of view. I'd like, therefore, take this opportunity to sincerely thank you, our distinguished speakers who have graciously to share their expertise, your willingness to contribute to the professional growth of fellow practitioners is deeply appreciated, and we are truly indebted to you. Do not take this for granted. The fact that you allow to take your time off, serve your society, serve the membership of the bar. It is really an honor. To all the participants, I encourage you to fully engage, ask questions, contribute to the discussion, and make the most of the experience and knowledge our facilitators bring. It is not every day that we have such engagements, and this is an opportunity we should all seize, we should all take up with full arms. Let this platform not just be learning, but for meaningful exchange and professional development, and learning from each other. We have facilitators. Let's engage them. Let's be active. Let's at least get out of this training with, some additional knowledge, additional information, and let it be, an interesting session. I thank you again for being here, and I wish you a fruitful discussion. I'll be online partly, but I'm sorry I have to leave at some point because there's a bar bench session, like I mentioned, where we have the heads of bars, and I'm supposed to share the members of the views of the membership to the judiciary so that they are addressed. So I'll be here virtually. Jump out at some point, but I'm also excited to learn, these new things and hear from our experts and the facilitators we have online. Thank you very much, and I wish you a great session. Thank you.
Thank you so much, Mr. Vice President, and thank you for all the work that you are doing. All the best with the bar bench session later this afternoon, later this day. And thank you again. So without further ado, I'll invite Mrs. Gertrude Karugaba to lay the land today, to lay out the land. She's going to be discussing M&A, the regulatory and legal landscape, and pointing out a few things to keep in mind and to keep at the back of our minds even as we go into M&A transactions. Over to you, Mrs. Karugaba.
Thank you, Jonathan, and good morning, everyone. It's a pleasure to be here and to share with you our own experiences on M&A transaction activity. As we go through the discussion this morning, you will notice that we will not talk a lot about what the law is. I think on the call we have all sorts of lawyers who know the law very well. What we want to do this morning is to share practical examples of what we've done, of what we've experienced, of what we've had. And hopefully by the time that we are done today, we should be able to practically walk away and be able to apply our skills or any information that we've acquired this morning. And so I'd like to ask, for some reason, my screen is not responding the way that I would want it to. So allow me to just ask Jonathan if you could kindly just put it up for me as I get started. And so what we want to do, like I mentioned, is to share overview of the commercial considerations for you as a practitioner, as you advise clients, whether they are selling businesses or clients who are buying businesses, to be able to support them effectively. And so if you find that the presentation is light on sections of the law, provisions of regulations, and so on, we want you to take the time to familiarize yourself with the legal framework, the detail of it separately, but to use the time that we have together to get more of the practical insights. And so the starting point for all of us as practitioners is to understand why the customer or why your client wants to do what they want to do. Because when you're advising a client, you're not advising in abstract. There is an aspiration they want to achieve. There's an ambition they have. There's a deal that they want to make. And therefore, from our perspective, it is important that we start there. Why is the customer or why is the client undertaking an M&A transaction? And when you look at the perspective, Jonathan, sorry, you'll have to move the slides along. My system is hanging. If you can move to the second slide, please. When you look at the transaction, there's always two sides of the coin. Sometimes there are three parties involved. Sometimes you have a holding company. Sometimes you have individual shareholders. Sometimes you have management getting involved. But for purposes of the discussion, we'll keep it at a basic level. There are two parties. One is buying a business. One is selling a business. And so if your client comes to you and says, I have a business that I want to sell, it's important for you as counsel to start by understanding why do they want to sell the business? Because later on, as we discuss all the way up to the presentation Navo will make and what Moses will say, you'll understand that if you didn't understand the rationale for the transaction in the beginning, you're likely to make mistakes along the way and ultimately cost the client value or business or employees or strategic push that they may be looking at. So the first thing usually when you're a seller is to say, why am I selling? The first thing could be that I'm shifting strategy because, for example, I have been operating as a provider of raw materials, and maybe now I want to be adding value to what I'm producing. And so I might say I am getting out of primary production. I want to go into value addition. I want to do manufacturing at scale. I want to expand and be closer to the market than the primary producer. And so because of that, I might then say, let me dispose of the primary production facility and invest the resources, the money that I get from the disposal in something that helps me to move alongside that strategy. But sometimes it's an issue of returns, because when you start a business, there are certain earnings that you're looking for. You have return on equity objectives that you're looking for. You want to be as efficient as possible to continue getting or earning more from your business. And so sometimes you might say there are certain assets that I am carrying. Typically, and Naval will talk about that, you may have a large real estate portfolio, but your business is a banking business. You're not in the business of buying and selling land and properties and houses and so on. So you might say maintaining a real estate portfolio costs me a lot of money. There's a lot of risk. People might steal the land. I need to consistently carry out land searches to make sure no one is taking my land. So you might say these are non-core assets. They don't help me as much as other business assets that I have. And so you might want to dispose of those as well. Sometimes the cost of compliance is too great. Depending on the sector that the client is operating in, they might find that the pace of change, and financial regulation is critical. The pace of change can be too high, too onerous, too challenging for you to continue operating in that sector. Recently in the region, there's been, and in fact in the continent as a whole, there's been changes, for example, in minimum capital requirements. So you might find that getting to the minimum capital requirement of 150 billion shillings, if you're in Uganda, for example, is too great a burden for you as an owner of a business. So you might decide, let me step back, sell this business to somebody else, cash out, and let them deal with the compliance burden. But sometimes it can be the regulator coming in. If you look at financial services, for example, the Financial Institutions Act has a whole section on resolution of banks that may be failing. So So it might be that the shareholders or the owners of the business are comfortable to keep running it, but the regulator might force them to either reduce their stake for purposes of financial stability, or the regulator might require them to dispose of their entire stake and for other people to come in and manage the business. So sometimes the seller is selling involuntarily. They are not looking to make money, but the regulator has put them in a position where they must do it, or the compliance burden has become much greater than they want to engage in, or the market environment in which they are operating has changed so significantly. Sometimes inflationary pressures can become too difficult to bear, and overall you find that the earnings that you're taking away don't make sense. So it can be taxation pressures that might come in. So overall, again, if you remember that your client started a business to generate value and maximize the benefit to themselves, if there is a threat to their ability to earn or to earn predictably, then they might be minded to exit the business. But it may also be, like I mentioned, it may be an issue of returns of investment, or it might be that the risk of continuing that business is too high. From a financial services perspective, we always talk about cost of risk. And at a basic level, you look at the quality of assets. If I am in banking and I am selling loans, I'm giving customers loans, customers are not able to pay because maybe the market environment is too difficult, or they are unwilling to pay, and I have to go through a court process, and the court process takes me time, and I continually have to make provisions and reduce my earnings at the end of the day, then I might say that market is too risky for me. I'd rather exit, cash out, and go to another market. But sometimes also the investor has a horizon. You know, if you're a private equity investor, you're not in it for life. You have a horizon 5 to 7 years, maybe up to 10 years to be invested in a certain asset. So when your time horizon comes up, sometimes you will have had what they call liquidity events. You might say, my time is up, I need to exit. So understanding, again, why is the client exiting at this point? You might have a view. You might say, this business is still very attractive. Why are you exiting now? There may be certain investment considerations that are driving that. Sometimes it may be that that portfolio represents a larger risk on the entire portfolio than they are willing to bear. So it may be that it's attractive for them to continue, but they are not able to exceed a certain investment threshold. Typically, with private equity funds, they have investment policies. They have limits on how much they can invest in certain sectors, in certain companies, in certain markets. And so when that threshold is exited or is at threat or at risk, then they may have to exit. But sometimes you've had the principle that small of big is better than big of small. So sometimes you may allow a transaction to happen that helps your company to be absorbed by a larger business. That gives you access to a wider pie, wider earnings, especially where the business that is buying your business is diverse in how it's operating. And so it may not be necessarily that I want to get out of business, but it may be that I want to be able to participate in a larger enterprise. And sometimes it's just viability and survival. When you're too small and you still have the same compliance burden, you still have to have a certain management structure, you still have to do filings, you still have to maintain capital. Sometimes you might say it is better that I sell down a portion and I'm absorbed by something bigger and I'm able to survive. So from a sell side perspective, it's important for you to understand, why is the customer or why is my client looking to sell a business? Sometimes it's not obvious. If it is a poor performing business, you might say it's obvious. They want out, they want to try something else. But when the business is performing well, sometimes you're wondering, why would you want to do that? And just giving an example of strategic shifts, I think you would all have heard last year Standard Chartered said it was getting out of certain markets, including Uganda. And I think what they articulated in their announcement is they want to focus more on serving their corporate and institutional clients. Now, you may have a view, you might say Uganda has a large dividend of youth. Why don't you want to serve retail? But for them, that's the strategic direction that they want to take. And so it's important to understand that. On the buy side, which is where I have been most of the time, it's usually considerations about being able to access markets or geographies that you don't operate in, or being able to get to sectors that you don't operate in, or being able to acquire capabilities that you don't have. You may find that your strategy is anchored on technology capabilities, but for you to develop those capabilities quickly enough for you to go to the market and sell might take you too long. So the client might look around and say, if I acquire this technology company and I acquire this other company and I bring everything together in one shot, I have the technology I need, I have the resources I need, I have the sector expertise that I need, and I'm able to go and grow in that market. And ultimately, when you acquire a business, you're looking for growth, which may be scale, just a larger business than you have, which may be scope, which may look at the breadth of the activities that you have, or it might be geographical expansion objectives. You want to go into new markets, or sometimes you see an opportunity, but it will take you too long to develop a solution or a product to tap into that opportunity. So you might buy a company that has what you need in order for you to get to market quicker. Sometimes it's about, I called it greenfield anxiety and risks, the fear of the unknown. If you get up and you say, I want to go and establish a bank, for example, in Mozambique, you'd be wondering, I'm not from a Portuguese background, how will I be able to integrate in that country? Do I understand the law? It's not common law. It's a different sort of legal system. Do we understand it? Do we understand labor practices? Do we understand regulation? Do we understand how the courts work? So that can create an anxiety that makes sense for you to say, let us rather buy a business that already exists. But sometimes you have invested significantly. Sometimes your client has invested in technology. They have invested in best-in-class technology, and they realize that for them to get the return that they are looking for requires for them to do more activities, more transactions, more businesses. And so they might say, for us to optimize that investment, we want to be able to acquire another business that helps us to leverage that. Or it might be a distribution network. Maybe you have infrastructure everywhere. Let's say you're in telco, you have towers everywhere. At some point, you realize for you to have towers that are exclusively for you doesn't make financial sense, because on your balance sheet side, it's driving significant depreciation. So you might say, instead of me continuing with my own network or my own distribution, how about I crowd in other potential businesses to help me to optimize that investment. Of course, you want to remain competitive. At the end of the day, when you're in business, competition is, you want to be ahead of the competition. And so sometimes you're going to go through a transaction to be able to grow in the market, to get ahead. If you have aspirations, your client might tell you, I want to be number one or number two in the markets in which I operate. They want to be ahead of the market. But they might also say, because if I'm number one, I'm able to play a broader role in transformation or economic transformation or whatever the case may be. And so it's important to understand that. And then sometimes it's just building resilience in your business, because sometimes you may have started a business in the middle. For example, you are manufacturing steel bars or rebars, but then you realize you have to import the raw material from Japan, for example. It takes time. There's a risk of loss. The train doesn't work as quickly as possible. So you might say, why don't I also acquire the capability to generate value at the raw material stage. So long and short from this slide, the key message is for you as a transaction legal counsel, you have to understand what your client wants to achieve, because that will inform the next steps of the process, whether you're going to do a due diligence. How you do the due diligence must have regard to why the client wanted to do this transaction. How you draft the documentation, how you negotiate, and so on, will all be anchored by that. Now, when we come to the next slide, Jonathan, which is the legal and regulatory and ethical considerations, the main point there is that M&A transactions are not done in abstract, particularly where you are in a regulated environment. If you're in financial services, for example, you're in technology, for example, you're in telco, you're in mining, there are certain sectors that come with specific requirements for you to buy an asset, for you to dispose of an asset. And so for you as a transaction legal counsel is to understand which sector or sectors is my client playing in, and what are the requirements for that specific sector. But Naval and Moses will talk about some of these elements, so I will not spend a lot of time on this. For example, what is the type of transaction? Is it a share purchase, or is it an asset disposal? You have to be able to understand the consequences of those two types of transactions. Because if you buy shares, yes, you become 100% shareholder, but what are you carrying with that transaction? If you buy assets, the question will be, what are you leaving? What value are you leaving on the table? So Nava will talk about transaction structures in more detail. And then when it comes to the legal due diligence, because that's where most of us come in, and often we are asked to conduct a red flag due diligence. But in practical terms, and maybe later when we have time, some people might say that a red flag is a phantom. In fact, you find that a red flag due diligence for you as legal counsel is always a little bit of a risk, because what you might consider significant for you might be insignificant to your client, and vice versa. So it's always important to agree with your client. What are the thresholds? When you say to me you want a red flag due diligence, what matters to you? If it is legal claims, maybe it's litigation, what is material to you? Is it 200,000 claims? Is it $1 million claims? Is it $5 million claims? So getting those parameters clearly is critical. Otherwise, your red flag due diligence will not be helpful to the client. But more than that, the client will say they paid for something and they didn't get value. So it's important that you understand what is important to you. What are those things that will make you walk away from a transaction? Not from your perspective as a lawyer, of course you should advise, but what will make that person who really wants to expand, who wants to scale, what will scare them away? And so it's important that you understand that. And then, of course, as the transaction progresses, you may have the opportunity to do a deeper confirmatory due diligence. So that's a place where we play. Of course, we play a critical role in the transaction documentation, working with the rest of the team, right from when we start. The non-disclosure agreement, usually it's sent across and your client says, can you have a read at this? And sometimes as a lawyer, you will say, this is just an NDA, let's wait for the big deal, which is the share purchase agreement. But it's important that you pay attention to the NDA, especially if you're representing the sell side, because the information you're disclosing, typically you're selling your business to somebody in the same space as you. So how much information are you disclosing? And what do you want the other party to use it for, especially if the deal does not work out? So paying attention to the non-disclosure agreement or confidentiality agreement is critical. The level of disclosure, but more importantly, what can that information be used for, and how long can that NDA hold? So again, sometimes we rush to the share purchase agreement and we really apply ourselves as lawyers. But if the deal does not work out, the NDA will protect us or it will expose us. But on the side of the buyer as well, because you're in the same market, the extent of restrictions in the NDA are critical. Because if the person selling to you says, for the next 10 years, you will not be able to operate in the market or to hire any of the people that I work with or to operate in a region that I operate. Basically, they are killing your business. So as an advisor, it's important that you pay attention to that. And Naval will talk about the other elements as well. But the other side also in the schedules, sometimes we get tired. We focus on the main body of the agreement. We don't care what's in the schedules, what's in the appendices. And then when a dispute arises, we go to the body and we say, you didn't provide this, or you didn't say that, or there's a claim here. And the counterpart says, no, but in the schedule, we made disclosure. We disclosed all the litigation. We disclosed all the employees with issues. We disclosed all the disputes relating to the land. So what are you talking about? So as a lawyer, my call on you is to be diligent from the start of the process all the way to the end. Always assume that the deal will work, but provide yourself and your client the opportunity to walk away and to walk away able to continue running their own business. Of course, there is enhanced merger control. I think 3 years ago, we always used to advise clients when clients would ask, do you have a law on merger control? We always said, no merger control, nothing applicable. That has since changed. We now have the Competition Act in Uganda, which has a section or part 5 of that legislation, which talks about merger control. What is a merger? What's a notifiable event? How you notify. The Ministry of Trade is the regulator for purposes of mergers and acquisitions. So those provisions then govern what is a merger, how do you notify it, what are the considerations that the ministry will have in evaluating your transaction, how much time the ministry has to make a decision, and what happens if the ministry doesn't make a decision. So that's the one thing from a local jurisdiction perspective. You now have the Competition Act, and it's very clear as far as merger control is concerned. Of course, you read that together with any sector-specific regulation. If you're in financial institutions, your client is providing financial services, pay attention to those provisions of the Financial Institutions Act that deal with transfer of businesses or with change of control, because there are provisions that deal with change of control of a financial institution and the approvals that are required for new shareholders coming in. But there are also provisions that deal with transferring, for example, a banking business from one bank to another. So appraise yourself with of the regulatory specific to the sector that your client is operating in. But also what has changed in the last couple of years, in fact, as recent as last month, we always used to have another question. There is an East Africa Competition Act. Does it apply to Uganda? And of course, we always said, no, it doesn't apply to Uganda. We don't have local regulation. Now, as of last month, the COMESA Competition Commission is now, has been given the mandate to operationalize and implement that East African Community Act. And I believe it will start receiving applications with effect from 1st November. So for us as lawyers who have our template of legal opinions where we've been having not applicable, the call on us is to familiarize ourselves with how those frameworks work. So you have your local Competition Act, you have the East African Community Act, and then of course you have the COMESA competition regulations, Article 23 and the articles that follow, also understanding how the assessment is done, especially from a turnover perspective. There's always debate about what transaction is actually notifiable The regulations, COMESA regulations, talk about a transaction having a regional dimension. And of course, when you read, you're like, can you give me a definition? And somehow merger control and regulations are always somewhat ambiguous. And in the regulations, they conclude by saying, just because it's not notifiable doesn't mean that there may not be local requirements. And so it's important, basically, that you appreciate merger control requirements. I've talked about the NDA, and I think for me, what is critical there is understanding the regulation or the provisions you have in there on non-competition and stuff. Usually your NDA will say you will not use the information that we've given you for your own business. You will not hire the people that you've worked with to work with you. And that's fair. When you're doing a deal, we have to work in good faith. But what is the limit of that? What if their employee who you worked with on a transaction decides that they like the buyer side so much, they would like to go and work with them? What is the liability there? But of course, there's also elements of data protection that come into it as a legal advisor, particularly as you're doing the due diligence and as you are, of course, supporting the client throughout the process. Corporate and securities regulation, again, these are matters that most of us on the call know very well. Of course, if you're a listed company, there are takeover regulations, there are thresholds in there. So if you're advising a client who's listed, who's a financial services provider, who has a shareholder outside the jurisdiction, you can see the level of complexity all the way from the Local Competition Act, the takeover regulations from the CMA, the East Africa Competition Act, the COMESA regulations, how all of those come into play and the interplay that comes with. Moses will talk about the labor law issues, so I don't want to labor so much on them, but I want to just talk about professional ethics and conflicts of interest. Sometimes in transactions, we'll get to know a lot of information about the seller or the buyer. How do we as lawyers limit our ability to use that information for other transactions that may come up, or other clients? For example, if you're a lawyer for Equity Bank, and Equity Bank is doing a deal or trying to do a deal with Stanbic, for example, and you're instructed to advise Equity Bank, if as part of that process you acquire information that is clearly proprietary to either one of the parties, how do you ensure that you don't try to appear smart when another bank, maybe Centenary, comes to you and says, we want you to advise us on this kind of deal? How do you draw the lines between what your clients have entrusted you with and not using that information for other transactions? Tax is a big issue when we are doing a transaction, and Navo will talk about that. Tax is always at the top of it. If it will not work from a tax perspective, it will be very difficult for us to do the deal. But then you have other elements, softer elements, anti-bribery and corruption. This business that you're trying to buy, was it obtained in through legitimate means? If it is a big contract from government that you're targeting, for example, was it legitimately obtained? Or is it a transaction you'll do, you will start running the business, and then an investigation is done by Parliament, and then they'll say the heartbeat of the operation that you bought was actually a transaction that was obtained unlawfully or through corrupt means? And how does that then not just affect your business, but how does it also expose you as a buyer, or of course, unlikely a seller, but as a buyer, to reputational risks and of course other consequences? And then finally, societal or social and environmental impacts are becoming a critical piece. And now you've all heard of greenwashing. So if somebody is trying to sell you a business that is very active in the environmental space, maybe it's an agriculture enterprise or whatever, how do you ensure that you support that client to address the social and environmental impacts of what they're doing? Because ultimately, a client might say, I want this farming business so much, I'll do whatever it takes. But your role as a lawyer is to say there are certain issues from a compliance perspective. There are certain NEMA regulations that were not complied with, which could expose you in the end. So the detail of this will be covered as we continue in the conversation, but I just thought that I would give that overview. I'll go to the next slide, Jonathan. And this is just an overview of key transaction risks for the parties. Again, I'm coming to this partly from the perspective of being a lawyer, but also from a perspective of a person who sometimes is responsible for buying businesses and integrating them. So, of course, the first thing is sometimes things change. It looked good, it was a good market, it was a good opportunity, it was a good business, but sometimes things change in the environment. Market conditions make it maybe difficult for you to continue that business once you have bought it, or you find that the macroeconomic environment is becoming difficult. Maybe inflationary pressures have kicked in, which were not there before. Maybe the regulator now says you have to increase your provisions or the provision methodology. I'll continue using banking as an example in a way that doesn't make sense. Or the business doesn't continue to be the rosy business that it was before. So as a lawyer, how do you ensure that you provide protection to your client for that eventuality? So I think Navo will talk about material adverse change clauses as being critical clauses for you as a lawyer to be involved in drafting. Things can change. And when things change, they can affect the value to your client of the business they wanted to sell, or even the circumstances of the buyer to whom they wanted to sell to. So giving your client the opportunity to walk away if it doesn't make sense is critical. However, you need to be careful not to undermine the client's strategic intent by exaggerating. Sometimes we can exaggerate a risk in a way that makes the client walk away. Of course, there are regulatory risks. I've mentioned that you have merger control. If it's a cross-border, the transaction has a regional component, you're dealing with multiple regulators. You may be dealing with the telco regulator, you're dealing with the COMESA, you're dealing with the Kenya regulator. So that exposes your transaction to significant delays, sometimes onerous approval conditions. It's been in the media, for example, there was a story that was covered of Access Bank in Nigeria. They wanted to buy a bank in Kenya, National Bank of Kenya. And what was in the news was that the regulator in Nigeria said, it's fine for you to buy a National Bank of Kenya, but for you to do that, you need to divest certain of your interests in the DRC and in the UK. So as your client might then say, what is most important? Is it this deal, or is it preserving the entire enterprise? So sometimes conditions can be onerous and there can be delays. The good thing in Uganda, the law is telling us that if after 120 days you have not heard back from the ministry, you take it that the transaction is approved. We'll see how long that holds and whether that then is supportive of what we want to do. There's also due diligence gaps. I mentioned sometimes the red flag due diligence and how that can be potentially risky, because when your client tells you do a red flag, sometimes we just want to save money. And so we say, tell me the most important things. I will figure out the rest of the issues. But in fact, that can expose your client later, because there may be disclosures that the seller has made and they believe you know what they have told you. And later on, when you say, we were not told that, Of course, the client will say, are you sure you are not told that? You say, then you'll tell your client, you told me to do a red flag due diligence. And the client will say, but you had access to the entire data room. You should have read through and seen what was there. So sometimes you find as a transaction legal counsel that you can make mistakes. There can be gaps that can be costly to your client. When you're working in a data room, sometimes the level of information is overwhelming, pages and pages of information. If you accept the mandate to be a transaction legal counsel, be ready to do the work, to read everything, and then synthesize and come up with a red flag due diligence. And even as you complete the transaction and the share purchase agreement or the business sale agreement is saying, you have received all the information that should be received, the prudent thing is to go and bring out an index from the data room and attach it to the agreement and initial it to make sure that you don't find the seller saying, I told you this, and you're saying, no, you didn't tell me that. There's also, I called it valuation risks, but Naval would want me to call it uncertainty in the proceeds. If on the side of the seller, they have a certain expectation, I want to receive $50 million. Do they get the $50 million? Sometimes they don't, because sometimes currency fluctuations might happen. If we do the deal in Uganda shillings, but I'm expecting dollars, there's a currency risk there that I have to deal with. Sometimes it's taxation. We have in the Income Tax Act, we have provisions on withholding tax on disposal of business asset. So all of a sudden, I was expecting $50 million, but then I have to pay, or the buyer has to withhold a portion of the 50 million and remit it to the Revenue Authority. Of course, the buyer will tell me that I can get a tax credit for it, but that assumes I'm going to be around conducting other business in order for me to take benefit of that price. So the price might not be the same when the transaction is done from the seller side. Sometimes we may negotiate recklessly, indemnity clauses. We may not pay attention to limitation of liability clauses. When a claim is asserted, that is going to reduce the proceeds to the client. So there is elements that you have to pay attention to. My client wants 100 million. How do I make sure that my client is able to get 100 million or as close as possible to that 100 million, that I'm not exposing them to adjustments, to tax risks, to exchange rate issues that might reduce the value to them of the transaction. Of course, disputes do arise. Transaction disputes, post-transaction disputes arise, particularly where you have some shareholders, some sellers staying on. Because if sellers are staying on, you typically have a share purchase agreement, a shareholders agreement, which will give them certain rights as minorities. There may be certain reserved matters. For example, you might say reserved matters appointing the managing director and the chief financial officer requires all shareholders to agree. But if you're owning a business 90%, do you want to be straddled by a 10% shareholder exercising a veto as to who will manage the business? So the post-transaction disputes can arise, and they need to be, if you're negotiating the shareholders agreement, assume that there may be a dispute. Is it clear how that dispute will be resolved and what that dispute, if it arises, what it means for your client? But sometimes it can be third parties. Not everyone is happy about a deal. It could be suppliers. It could be employees. It could be shareholders. It could be any sort of claimant that could come up. Now we'll talk about limitation of liability, but again, how do you ensure that you're not dealing with claims? Sometimes the transaction happened 3 years ago, but you're still entertaining claims. As transaction legal counsel, assist your client to limit their liability not just in quantum, but also in the period of time to the extent that you can. And also let the buyer be willing to take some risks. It shouldn't be that the entire risk should be transferred to the seller unless you don't want the deal to be done. There may be an issue on strategic misalignment, especially when you keep on certain of the shareholders from the other side. You may be going this way and they don't really agree. Again, if you've said that we will agree on strategy together, you might have problems. And then, of course, sometimes because you're acquiring a new business, there could be clashes of culture. There could be greater expenses than you anticipated and so on. So how do you assist your client to ensure that these sort of things don't happen? It could be as basic as saying, for the first 1 week, you call your staff, we all come together, you introduce us as the buyer, and you tell them all the great stories. But it could be something more complex, like a system issue. Because if you're buying a business that is dependent on a system provided by, for example, a shareholder, you can't just switch off and say we switch off on Friday and on Monday we start running from our system. There are certain migration components that need to be covered. So you may want to advise your client on certain, to inquire, are there transition arrangements that may be required? It might be the MD. Maybe the MD needs to stay on for another 6 months to deal with that migration of culture. So don't be reckless and just say on day one, the entire board should go away, the entire management should go away. There could be issues. And another element of migration or integration is even boards. I think we had a transaction once where, in your typical documentation, you say on completion, all the directors of the seller will resign and I will appoint directors as a buyer. But if you're in a sector that is regulated where you need to conduct fit and proper assessments for board members, you could easily find yourself at a point where you cannot operate because the old board has resigned on the completion date, but the new board is not yet constituted because you're waiting for the regulator to approve. So those are elements that you want to be on top of. Don't assume that integration will be seamless. Assume you might need some staff to stay on. You might need transition support for systems. You might need support for processes, and so on and so forth. And then, of course, employee and customer attrition. Sometimes people don't necessarily like the buyer, and so they might decide to leave. How do you ensure that you protect your client from significant employee and customer attrition that makes what they have bought an empty shell? So, of course, careful, and Moses will talk about that, restraints of trade, how well do they work, and so on and so forth. But how do you assist your client? In the interest of time, Jonathan, there was a final slide, but we can, when we circulate the document later, it can be shared. Just really on trends. This is more of context, just information. I don't think we need to spend a lot of time on it. But maybe finally, as I close, 3 main points on that slide. Of course, technology is doing a lot of work. AI is doing a lot of work from a due diligence perspective. So for those of us who are earning money from doing due diligence, how do we embrace artificial intelligence to help us to do the work? Because clients are not going to pay a fortune for you to do work which a machine can do for them. So how do we remain relevant even as technology comes in? I think the final one is tariffs. Tariffs are critical considerations in this day and age because they change the profile. When you talk about material adverse change, today you do the transaction, everything is in order. About a month before you're ready to complete, you realize the US has slapped sanctions on Kenya. That has changed the environment, the ability to sell. Maybe the US was a critical market. Now it is at risk. So those are things that we should have regard of. So I want to pause here. Thank you, Jonathan and the team. There's some additional reading. We'll share the documents later, but I want to hand over to Naval to take it away from here. Thank you, Jonathan. And I think we'll take questions later. Thank you.
Yes, thank you so much. Thank you so much, Mrs. Karagawa, for that presentation. We can all agree it was a very useful presentation. I think two takeaways is we must understand the why. I think as lawyers, we're often too quick to jump into the due diligence process and without understanding why the sell, why we are doing what we are doing, why the buy, why we only want to buy shares and not the other assets and things like that. But I think once we understand the why, then it makes us better advisors. And I think, as we get into the due diligence and even the negotiation of documents, I think you emphasize the need to be thorough. I think as young lawyers, that's something maybe at times we fail at. So that's something we'll take to heart. Without further ado, I've taken note of the questions and the chat. It's an active one. Perhaps you could look there for a few of yours. I'll read them later, but you could just prepare. And while we do that, we'll move right to Naval and move on from there. Thank you so much.
Thank you, Jonathan. Thank you, team. Yeah.
So I'll just invite Mr. Naval to go on from here, to take it from here.
All right. Good morning, everyone. And thank you, Gertrude, for that presentation. As Jonathan set out, I want to make it clear, I am not a lawyer, but I'm an infiltrator from the world of accounting. But I've spent most of my life doing M&A transactions, all of which involve me working very closely with law firms, to the extent that when I retired from Stanbic, I think about 80% of the people invited there were lawyers. And also, maybe just to tell you a little bit about myself, one of my claims to fame is that when I was sitting my accounting exams, and remember that this is back in 1980s, well before the time of the internet, for my law paper, I had memorized more than 150 UK law cases. And even today, if I hear the words Ibrahimi versus Westbourne Galleries or O'Neill versus Phillip or Invitation to Treat, it creates flashbacks. Most of my current colleagues and friends think that that's a really sad existence. But hopefully this audience will have a slightly different view of that. So, welcome. I'm as Gertrude said, I'm going to spend a bit of time really going over more of the practical aspects of what we see when we do transactions. So really bringing quite a lot of the stuff that Gertrude has spoken about and that Moses is going to talk about in a bit more detail around the employee side, but trying to put that together in terms of what actually happens on deals and what are the sort of key considerations that we as transaction advisors, our client, and the legal advisors all have to discuss and debate early on as we proceed through. So, and let me also just say that all of these slides, I believe, will be made available to all the participants. So please don't worry about the large amount of content on each one of them. You will get the slides, and so that you can look at them in your own time as well. So what I'm going to cover is sort of the M&A deal life cycle, and then the key considerations. What do we buy or sell? What sort of price adjustment mechanisms do we have? How do we mitigate risk? And then talk a little bit about earnout mechanisms and whether you should use them, and if so, how. And then just finish off with a few closing thoughts as to how we can do better for our clients. So I think the first thing is in terms of the deal life cycle, as Gertrude pointed out, certainly from a client's perspective, the deal life cycle is a lot longer than what we would typically see. So from a client's perspective, they start off with thinking about why do we want to do this deal? And that's an important aspect. And as Gertrude said, there's a whole range of reasons as to why they might want to sell businesses or buy businesses. We don't often get involved in them, particularly as law firms. As transaction advisors, sometimes we're at the heart of it. But whatever happens, it's important that you understand why the client is going to do something. We then go into the process itself, and the first bit of that process is around, what I've called identify and engage. And this is all about, if you're trying to buy something, then finding what you want to buy. If you're looking to sell a business, then finding potential buyers for it. And there's a whole process to do this. As transaction advisors, our job very much is around marketing businesses. If you're working on the sell side, advising clients whether they should run an auction or how they should go about finding people to buy the business. And once they have found somebody, either to buy or to invest, then there's a whole aspect about completing due diligence. And clearly, certainly law firms certainly must get involved at that point. Once we move on from there, then the negotiation and closing phase of it, negotiating the price and terms, documentation, obtaining the regulatory and other approvals, and closing the transaction. So that's, as advisors, that's what we see. But from a client's perspective, particularly if you're on the buy side, it's around integrating that acquisition and then actually capturing the value. And unless they get the entire life cycle working fully, that they may have wasted their money. So just re-emphasize again that when you're looking at a deal life cycle from a client's perspective, it's a lot longer than what we might think. And it doesn't end on closing that transaction. I think the second bit, we've spoken a little bit about due diligence, and clearly buyers want to complete due diligence in order to answer some critical questions, so that the deal has got some hope of delivering value in excess of the purchase price that they pay. And usually, almost everybody that we work with will want to do a financial and accounting due diligence, and that's really aimed at understanding, do the accounts make sense? Do they, what do we understand about their financial position, profitability, cash flows? They'll want to do a legal due diligence, and usually this is to answer questions around material legal liabilities, disputes, compliance issues, those sorts of things that Gertrude spoke about. Sometimes it's just a red flags report, sometimes it's a more in-depth report. And by and large, clients will also want to do a tax due diligence, really just to understand, are there any future tax costs that might arise? Or does the company have aggressive tax positions that might come, that might crystallize in real liabilities later on? So that's certainly something that people do. Some clients, do a much more, apart from the legal due diligence, do a much more in-depth employee and HR due diligence. And I know that Moses is going to speak about this quite a lot more. Clients will sometimes want to do a commercial and operational due diligence, really just to make sure that their understanding of the business model and how it delivers profits and how it could deliver profits in the future are understood and are credible. And particularly in regulated businesses, the whole sort of risk management side of things is a critical focus. So for example, when banks are buying other banks, they want to make sure that the KYC or the know your customer processes and compliance and everything is up to date. because on the day after you take over, you are then responsible for whatever faults that might exist in those processes and systems. So that's another sort of 3 sets of things that very often clients want to do due diligence on. Increasingly, clients are now wanting to do reputational due diligence, understand things like brand value, investor confidence, and understand whether those things might be at risk because of corruption or controversies or negative PR. And increasingly, environmental, social, and governance issues are also now being subject to specific due diligence as these matters become important for our clients. And then lastly, but not least, a lot of clients now want to do specific integration and synergy due diligence. And this really goes back to the point that Gertrude was making. If you're buying a business because you want to integrate it with your own systems and processes, you're paying a large premium for it. The only way that you as the buyer are going to make any money is if you're able to integrate that business quickly, use your own systems and processes, and you're able to win in the marketplace. And to deliver the cost synergies that Gertrude spoke about, whether they're reduction of costs or new customers or any of those things. So increasingly, as transaction advisors, we encourage our clients to do specific integration and synergy due diligence. Sometimes it gets wrapped up into the commercial side or employee side or sometimes the legal or the financial. But paying attention to this, I think, is extremely important. So overall, lots of things that you can do on due diligence. As I said, there's standard lists that everybody has. But the important point is that you must really understand what the client is trying to achieve in order to be able to modify what you do to suit your client's requirements. So do ask the question, why are you doing this? How do you want to make money going forward? And what can we review in order to give you the answers that you want? I think our role as transaction advisors is, certainly as transaction advisor, I don't do any due diligence. But I read every single due diligence report. And I work with the providers in order to make sure that they understand the scope and that they're doing what they're supposed to do. And then read the outputs to talk to our clients about what it then means for the transaction. So the first bits are, decision that we try and talk about is, what should we do? If I'm on the buy side, should it be that, we buy the assets and bits of it, or should we just buy the shares or something else? We talk a lot about price and the price adjustment mechanics, and I'm going to speak about this in a little bit, in quite a bit more detail shortly. We talk a lot about what impact those due diligence findings have on the commercial deal and how we negotiate terms of the contract, including things like risk mitigation. And all of that ends up in the share purchase agreement or asset purchase agreement or share subscription agreement. But on the other side as well, we talk to our clients about what do they want to do with the business going forward. And so what are you going to do with the business as soon as you bought it? And so what are your growth and synergy plans? How do you intend to run the business technically in board participation? And sometimes, how do you want to exit from that business? And these sorts of matters all end up in things like the post-investment shareholders agreement, if some of the sellers are staying on, or it could be in the form of service agreements that Gertrude spoke about. Sometimes you have things like transitional service agreements to ease the transition between the buyer and the seller. And it may end up as part of the business plan for that business going forward. So really, we as advisors need to be the link between what we find on the due diligence and what ends up in the agreements. And that's where you need significant collaboration between the legal team and the technical advisors, and the transaction advisors and the client themselves, in making sure that those findings actually end up appropriately in the agreements. I mean, the worst transactions we've ever had are where everybody is doing their own thing and nobody is actually bringing stuff together. So the lawyers are just writing their agreements based on the last one that they wrote. The client has got a business development team who is incentivized to do the transaction and then run away. And nobody's really thinking about tomorrow. All of them just want to get the deal done today. And then almost inevitably tomorrow, the problems surface. Okay, moving on to the first critical consideration. What is it that we should buy or sell? What happens sometimes is when you look at a business, you find a target that you want to acquire, you think it's a good business that you want to buy. But when you look at it in a bit more detail, you find, yes, there are certainly a lot of things that you like: the assets, the activities, employees, suppliers, customers, a great deal of interest to the buyer. But sometimes they come with assets that you don't really want. They might be sort of surplus commercial property that they have, or all sorts of weird and wonderful things that business has acquired over the years. Sometimes it's about employees. You might want all the employees, but you also notice that the seller has employed half of his family, and you don't really want them to come across with the business. And clearly, there are unwanted liabilities. There are liabilities that you do want. Those payables to suppliers, borrowings, those sorts of things you do want. But there may be things like, old tax disputes or pension fund liabilities or promises, gratuity promises that were made that you don't really want to bring across with you. So in that sort of a situation, you have a choice. Do we then advise our client to say, buy specific assets and liabilities only? Or do you buy the shares and live with everything coming across? Or do you tell them that you want to buy the shares, but you will only buy the shares after they've done certain things, like they've cleaned up and they've removed the properties you don't want, they've terminated employment contracts that you don't want, and potentially have set aside money or have settled disputes. That decision is driven by a whole host of things. So you need to bring together commercial, tax, and legal considerations for this. So, risk, clearly, the legacy liabilities typically come across with shares, whereas when you do an asset purchase or a business and asset purchase, you can possibly leave them behind. But of course, even if you're getting those legacy liabilities, you can get some sort of protection through warranties and indemnities, which we'll speak about. You have to consider tax. Usually, asset purchases are great for the buyer, but terrible for the seller. But not always the case. But you need to understand the situation in that particular transaction. Execution. Clearly, if you're buying business and assets, you're then having to transfer individual assets across, which you may or may not be able to do quickly and easily. You may need a lot more regulatory approvals. And then the whole issue about employee law comes into place that Moses will talk about. Commercial, again, there's more continuity if you buy shares because the entity still exists, existing contracts still exist. Things can proceed almost as is. Whereas if you're transferring business and assets, very often suppliers take the opportunity to either jack up their prices or cancel contracts and things. And then the price impact, can be quite different, as I said, particularly because of taxes, but because of also how liabilities play out. And so, what we typically find is, buyers typically say, we want to buy just the assets and business. Sellers generally say, they resist that approach and say that they want to sell the shares in the company, largely because of higher taxes and complexity. But those are the sorts of sort of pros and cons that you need to discuss and debate with your client. I know that I've spoken a lot about what the buyer wants, and them not wanting things. But equally, it can apply when the seller is thinking about selling. Gertrude spoke about wanting to exit certain elements of your business because it's not profitable or it doesn't make sense or because regulators are forcing you to. So in those circumstances, actually, the seller will be the one that will be saying, we only want to set out or sell some parts of our business and not all of it. Gertrude used the example of Standard Chartered Bank. So clearly they're selling just their retail business. They want to keep their corporate business. So a lot of that transaction is about defining the boundaries of what it is that they're selling, and how they can actually transfer across deposits, loans, customer relationships, relationship managers, as well as some of the tools and technologies that are used in that business. So it's not always a buyer-driven thing. It can also be a seller-driven thing. Okay. The other key consideration is then about price adjustment mechanisms. And in all M&A transactions, generally you can adopt one of two approaches. You can either adopt a completion accounts process where the purchase price adjustments are only determined after you complete the transaction. And after you've produced what are called completion accounts, that actually set out what actually was delivered to the buyer by the seller. The other option you have is to do a fixed price or more usually called a locked box approach. And here the price is agreed before you even sign the transaction. And the price is then based on that locked box balance sheet. So you've agreed something based on a historical position of the company. And then that is the price that is paid, even at completion, of course, but it's based on a historical facts and circumstances. And typically locked boxes are usually only used for share purchase or share subscription agreements. Simply because it's not possible to do that, or it's technically very difficult to do that when you're doing an asset and business and asset purchase. Right. This diagram looks to sort of set out how that process works. And, the key dates here or the key elements here are lockbox reference accounts, signing, completion and initial payment, and then a second payment beyond that. And maybe just to make it a little bit easier to see, if you're doing a completion accounts process, generally while you're negotiating the deal, you're agreeing things like enterprise value and target working capital for the business. You sign the transaction, And then in that period between signing and completion, the seller completes pre-completion covenants, and these could include things like some of the cleanup that we've been talking about. And when you complete the transaction is when you make an initial down payment effectively. And that's the point in time when the economic risks and benefits pass to the buyer. And then after that, you do a completion accounts process, which then tells you how much additional consideration or sometimes a clawback you need to have to the seller. So that's the completion accounts process. When you're doing a lockbox arrangement, essentially what happens is that you agree a date for the lockbox reference accounts. So if I'm doing a transaction today, we could agree that the lockbox date is the financial statements as at 30th of June, 2025, for example. You complete your due diligence on this balance sheet and projected cash flows and cash profits and so on. And you sign an agreement that says, this is the price that we will pay. You have some restrictions on what the seller can do. So they can't reduce the value of the company by paying out dividends, for example, in that period. And then you fulfill all of these pre-completion covenants, which include getting regulatory and other approvals. And once you have them, the shares are actually transferred across, and you pay them the consideration that you'd agreed, plus sometimes you pay them the interest for the time period that it took to get from signing to completion. So that's the sort of diagrammatic version of these processes. And what we find in practice is that buy-side advisors typically push for completion accounts, whereas a sell-side advisor will say, absolutely not, nothing doing, you must do a lockbox arrangement. We want certainty. And ultimately, the mechanism that you choose really does depend to a large extent on the relative negotiating power of the two parties. Where the seller is running an auction and there are lots of potential buyers, they will, and they've done things like seller due diligence and so on, you may be able to enforce a lockbox mechanism. Where there's only one or two potential buyers and they've got exclusivity and everything else, and the circumstances are such that lockbox is very difficult, then usually we end up with completion accounts. But usually, the two arguments that people make, price certainty, for the buy-side advisors, they say we will only pay for what we receive. On the sell side, they're saying, but we don't care. We want to know what we'll get at signing, and we get certainty through doing that. We don't want you saying that you'll pay us something, and then we find that we get a completely different amount later on. Risk allocation. Clearly, the buyer is protected until completion. Because you're redoing the completion accounts at completion, anything that happens between signing and completion means that the seller loses out. So, for example, they lose a big customer in between signing and completion. Clearly, the accounts at the end, the completion accounts will have lower assets, for example, or let's say a factory burns down or something happens to the business. It should show up in completion accounts. And therefore, the seller bears the risk. It's completely different on the lockbox scenario, where the buyer bears the risk from the date of signing onwards. In terms of value leakage, and when we talk about leakage, we're talking about money leaving the company, and dividends are the simple example. Although there's a lot more to that, and I'll talk about it in a moment. But in In the completion account process, it's automatic. If the seller decides to pay themselves a big dividend pre-completion, that just means that there's less cash in the business at completion, which means that they get a lower price. On the other hand, on the lockbox, you have to set out very, very clearly and have very, very strong covenants and agreements that say what the seller can and cannot do. And they're not allowed to indulge in activities or transactions that are classified as leakage, except for things that you might agree that they can do, which is permitted, but anything else isn't allowed. But of course, you can still get away with it as a seller. If those covenants are not strong, you can manipulate your way to extracting money from the business. Complexity, clearly, completion accounts can be a lot more complex. You need to prepare closing accounts. You have disputes, and you have to resolve disputes around them. The lockbox is clearly a lot simpler and quicker in that sense, with fewer areas to dispute. Timing, you have to have two sets of payments, one at completion and then one after you've done the completion accounts. And that process itself can take 3 to 6 months. So you as a seller, you as a buyer, it's great. You hang on to your money for longer. As a seller, it's not, which is why they then push for the lockbox process. And as I've said, negotiation dynamics, usually buy side pushes for completion accounts and sell sides push for simplicity and certainty. And whilst I've said that it's a negotiating, a lot depends on bargaining power, there are factors that you need to take into account that argue for one or the other. So if you're advising your client, you should take a dispassionate view of things and help your client. You want your clients to reach agreement, and these are the sorts of tools that you can use to persuade your client to agree to either a completion account mechanism or a lockbox arrangement. So the first element is really around, what's the nature of the company in terms of profitability and working capital requirements. If it's very volatile, then completion accounts make sense. If it's very stable, then lockbox makes sense. What is the level of capital expenditure required, or the level of pre-transaction restructuring required, pre-closing restructuring required to complete the transaction? Again, if you're doing a lot of restructuring, you're having to do a lot of capital investment, then completion accounts make sense. Otherwise, lockbox can work. If there's a lot of related party transactions or funding or services, then completion accounts make sense, because those sorts of mechanisms can be used to extract a lot of value from companies. If there are very few of those sorts of activities, then again, lockbox can work. The length of period, if you think that it's going to be less than 3 months or so, then lockbox can work. If it's more than 6 months or so, then completion accounts are probably better. You might think that your transaction will complete quickly, but as Gertrude said, now you've got COMESA approvals to get, you've got Ugandan competition law approvals to get, you have sector regulators, all of whom can take long to complete their work, which then again argues for completion accounts. Can the company produce monthly management accounts? How accurate are they? If accuracy is high, then lockbox works. If they're not, then completion accounts are better. And also, what are the governance and other standards? So, you can use this sort of a tool, work out where you're at on each one of these factors, and you can then, lean one way or the other and persuade your client to act appropriately. if you are going to go down the completion accounts mechanism, then it's important also to understand what best practice is in these areas, and what are the do's and don'ts of this. So from my experience, best practice is firstly to specify the approach that is going to be adopted in preparing these completion financial statements. What then happens is that after you complete, the buyer now has to prepare management accounts or interim accounts. So they have to, usually you can't engineer things that you will always complete just before the financial year end. So almost by definition, when you complete, you will have to prepare interim financial statements or management accounts as at the completion date. From that, you then prepare pro forma completion statements. The parties discuss and agree these statements. And if they agree, well and good. If they disagree, then you refer disputes to experts. So that's in broad sort of extent. But in terms of specifying the approach, you need to do things like specifying when exactly are these completion accounts going to be made up to. And usually what you want to try and do is choose a month end that is close to completion. So either the month ended immediately after completion or the month ended immediately before completion. And the reason is just that companies have got processes in order to produce monthly accounts. And it's a lot more difficult to produce accounts, say, as at 12th of September, 2025. It's much easier to produce them as at 31st August or as at 30th September. The agreements should specify exactly how the purchase price is to be computed, what elements go into that completion statement. And typically, when you're buying a manufacturing company or that, you will have what is called an enterprise value to equity price bridge. And typically, this is enterprise value plus cash, less debt, plus actual working capital, less normal working capital to get to the equity price that is to be paid for 100% of the shares. And then, of course, if you're buying fewer, if you're buying only 60% of the shares, the price would be 60% of that amount. But whatever mechanism you're using, make sure that it's set out very, very clearly in the agreement, including things like pro forma calculations, so that both parties are clear as to how that mechanism is going to work. It's also very important to set out what accounting policies you're going to use. Is it going to be, IFRS, or International Financial Reporting Standards, or something else? Is it going to be the accounting policies that the seller had, or is it going to be the accounting policies that the buyer has? And those two can be different in certain respects. So important to specify what accounting policies you're going to adopt. And also very important to set out how measurement is going to apply. You might say receivables are to be, in financial statements, receivables are at the net recoverable value, or it's at the receivable less provisions for bad debts. But the question is, how are you going to calculate that provision? And the best practice is to actually set out, for things that are likely to be contentious, to set out measurement policies. So I've just set out one, for example, there, which is to say that all receivables that are more than 90 days old will be fully provided for unless the seller can demonstrate that the money came in within 2 months of the completion accounts date, right? So that may be, as I said, well, that's an aspect of measurements. Preparing the interim baseline accounts. So remember that these financial statements are going to be produced after the buyer has taken over. So usually it's the buyer that has to produce them. The seller usually doesn't have is no longer in the business. So they don't have the ability to produce this management accounts. But the buyer is coming in and very quickly has to produce these accounts. So usually they're relying on the systems and processes that were in place at that point. So you have to specify how that will be done and make sure that the client is setting aside appropriate resources to deliver it. Sometimes in agreements, you say, clients and say, oh, well, we'll just get those accounts audited. But that is not really a panacea, because the auditors can only audit what is put in front of them. They can't audit things that did not happen. And as I'll come to in a moment, sometimes these completion accounts have to actually take into account those sorts of elements. The next step is then the buyer prepares a pro forma statement from these management accounts. And the seller and seller's advisors can review the computations and the underlying books of account if they wish. And then you go on to the stage of, usually you want to set aside a fixed time period for that activity to occur, where, you say that we send you the statement, you've now got sort of 14 days to respond. If you don't respond, then we'll assume that everything is okay. If you do think that there is a problem, then tell us exactly what the problem is. And then we have a time period to negotiate that resolve those disputes. And only if we can't resolve the disputes do we then go to an expert in order to opine on how that dispute should be resolved. I think the point that I wanted to make here is that usually you need to appoint an independent accountant to act as that expert. Auditors typically would not take on such an assignment simply because it goes against the independence rules, because they don't want to opine on something that then ends up in the financial statements of the buyer. So usually you want to have an independent expert opining on these disputes. And again, I've acted as expert on some of these transactions, and it makes life a lot easier if the share purchase agreement actually set out the policies, the processes, and the measurement basis very, very clearly. Firstly, it just means that you're less likely to end up in a dispute. But even if you do, it's relatively easy to opine on. If you don't do those things, then you end up in long, drawn out and expensive disputes for your client. And a final point there. Please, 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 audited accounts are not completion accounts, right? They're two different things. They may draw on information from the same places, but audited accounts are not completion accounts. Just to emphasize that point again, as I said, typically the bridge talks about working capital, cash and cash-like items, and debt-like items. Defining these and exactly what goes into each one of them is very important. For example, working capital is not an IFRS defined term, and net current assets are not working capital. So usually you have to say exactly what goes into them. If inventories, trade receivables, trade payables, and maybe some other assets and liabilities. But again, the measurement of these is important. Cash and cash-like items are defined in IFRS, so you can rely on that definition if you want, but bring it into your agreements. But you still have to say, how you deal with things like restricted cash or retail cash floats or trapped cash. If you have subsidiaries that have cash that can't be remitted, and can't be used for to service debt or dividends, you may not want to count them as part of cash at completion. And then debt and debt-like items, again, are not defined in IFRS, but this is where you have a lot of issues. So things like, you want to be able to capture things like overdue creditor balances or extended supplier or credit from suppliers might go into debt and debt-like, for example, rather than being part of working capital. And very often, as I was saying, you want to capture things that have not happened. One of the big issues with doing completion accounts is you say, we will pay you for the cash that you have on the balance sheet at completion. If you're a seller, you very quickly twig on to say, if I increase the cash at completion, I get paid more. So why don't I just stop doing all repairs and maintenance? Why don't I stop doing all forms of advertising? I just stop doing all transactions. I don't buy any capital expenditure. I don't buy any more. I don't repair the machines. I don't replace them as they fall due for replacement. And on the other side, maybe I should just go out and sell as much as I possibly can, even though it's unprofitable and the customers are not great, because it increases the cash and the receivables at completion, which then increases the price. So in your agreement, you then have to set out all sorts of things to say, no, you, Mr. Seller, should not and must not do these sorts of things. And if you do, we will make an estimate for the problems that you've piled up for us, and we will add them to debt and debt-like items, and therefore we don't pay them. We don't increase the consideration to you. So that's what I mean by having those elements in the agreements. But it's also very, very difficult for auditors to audit. You can't audit the fact that you did not repair something. You can audit the fact that you repaired something and how much you spent on it, but not something that you didn't do. And yet, it's an important part of the completion statement. Contingent liabilities, actual liabilities, again, how do those fit in? If you have a big tax dispute, for example, it may be, for IFRS purposes, it may be a contingent liability because it hasn't yet crystallized, it's not yet probable. But you still want to adjust the price for those things. So then you just add it to debt-like items. And then also things that, costs that only crystallize after completion. So taxes that crystallize, sellers' transaction costs, staff bonuses, those sorts of things you may also want to add into your definition of debt-like items to make sure that adjustments are done properly. An example, I know that in Uganda, for example, in 2018, there was a capital gains tax amendment made that said that if there's a transfer of ownership of a Ugandan company by outside the country by sale of shares that happened outside, then the company itself is liable to pay capital gains tax in Uganda. So that's sort of a thing you need to capture as part of your completion statements in order to make sure that the buyer pays the right price in the second payment. Right, moving on to lockbox mechanisms. As I said, the principle is simple. You agree the price at a date in the past. You don't have any opportunity to change that price post-completion. There is this concept of leakage, which is to say, we agreed the position as a 30th June. You can't then pay out a big dividend. And if you do, then in that circumstance, we're able to adjust the price by the amount of dividend that you paid. And then there is the interest element as well. Sometimes, as we said, in order to compensate the seller for the delay between signing and completion. And as I said, essentially the purchaser takes all performance risk. So the key elements and the areas of dispute here are likely to be things like, what you define leakage and permitted leakage to be. And the point is that it's not just dividends. It can be things like management and technical fees. It can be things like loans to related parties. It can be accelerated payments for intergroup purchases. So all of these things can fall into the bucket of what is defined as leakage, for which you first try and make sure that the seller doesn't do it. But secondly, if they do it, then there's a mechanism for you to be able to claw back that from the seller. And the last bit is that, sometimes if you're doing a lockbox, you will seek warranties, and you'll seek it on the pricing balance sheet, which is the reference balance sheet. But the same issues for warranties and indemnities still apply as for completion accounts. And I'll talk about these in a moment. Right, moving on swiftly. Risk mitigation. So I'm sure, all of you, would be familiar with the whole sort of concept of warranties and indemnities. But just, running through them very, very swiftly. Essentially, the sort of warranty process in an M&A transaction is that the seller represents a statement, and then the buyer is able to claim for breach of contract if it's untrue. So, for example, the buyer might represent the amount at which I state, that receivables appear on my balance sheet are all recoverable. Right. That might be a representation that they make, or I have good title to all of my to all the list of properties that is set out in the schedule. I don't have any legal claims outstanding other than the ones that I've already told you about. So those are the sorts of representations that you make. And if it turns out after you bought the company that those representations weren't true, the buyer is able to make a claim. And generally these warranties are really good for flushing out the issues, or also for things that nobody knows about as at the date of completion. So it may be that the seller is not lying, but they just don't know that that somebody had filed a claim against them pre-completion, but they just were unaware of it at that point in time. So they will represent that there is no claims outstanding, but then 6 months later, it turns out that statement is untrue. The problem with warranties, though, is that you have to prove loss. And generally, the amount that you can claim is subject to limitations. And the other point is that if you as the buyer knew about that particular matter, then you can't claim. And that's why from a sell side perspective, it's extremely important to be able to demonstrate that you had disclosed to the buyer pre-completion and pre-signing those matters. Because every representation is, we have no claims other than those disclosed, and then you have to set out what you actually disclosed. So if warranties are not great if you know about that there is a problem. So if you know that there is a tax dispute that with the revenue authority, you might not know the full details, but if that tax dispute crystallizes, it's very, very hard to actually make any sort of claim against it. Indemnities, on the other hand, are simply the seller guarantees to reimburse. And you don't have to prove any loss. You just have to prove that the indemnified event occurred. Reimbursement can be subject to limitations, but it's a much more automatic remedy. So indemnities are great for known things. So, for example, you know that there is a dispute with the revenue authority. It may take 6 months or a year for it to play out, but you can get an indemnity, a tax indemnity against that known dispute. If the company prevails, great. If the company doesn't prevail and it has to pay penalties and interest and principal taxes to the revenue authority, then the buyer goes back. The buyer pays for it, but then goes to the seller and says, please settle that guarantee. And just to highlight the point around loss for warranties, typically the way that the quotes and interpret loss is to say there was a value of the business had that warranty been true, which is the warranty true value, and there is the value of the business because the warranty was false, and that's the warranty false value, and the difference between the two is the loss that you have suffered. So in principle, great, straightforward. The difficulty is actually doing those computations and demonstrating them and getting paid for them. And very often sellers as well don't particularly want to have that uncertainty as to what the claim could be. So they try and limit the mechanisms by which the loss can be computed and restrict it to things just like accounting losses, for example. In terms of, usually when we do these sorts of transactions, you go through a standard dance, and it's really funny when you're working on one transaction, and the lawyer on the other side, is banging the table saying, absolutely no way we're giving you any warranties or indemnities or anything like that. And in the afternoon, that same lawyer is on your side on another transaction, and he's saying, of course you must give warranties and indemnities. You do the best for your client. Generally, what happens in these situations is that the buyer's lawyer produces a laundry list, 20 pages of warranties and indemnities. You give it to the seller's lawyer. The seller's lawyer says, absolutely not. We're not warranting anything. We've disclosed everything. You've done your due diligence. You know everything about the company. No warranties and indemnities. You then either accept that position and you then go back to your client. The buyer says, okay, fine, we'll buy it on an as-is, where-is basis and live with it. Or more important, likely you go back to the negotiating table. The buyer asks for more indemnities, the seller refuses, and then you're back into this price adjustment or walking away. Or sometimes you then go back and refine the warranty list, and then you go through the whole cycle again. So these things take time. They need, patience, and they need an understanding of what you're trying to achieve at the end of the day, because you want your clients to do transactions, but to do them in a way that protects them. So you engage in this dance, play your roles, do the best that you can for our clients. I think even once you have agreed the list of warranties and indemnities, the focus then shifts onto, what are the claim limits? And typically in these share purchase agreements, you'll have overall monetary claim limits. Usually from the seller's perspective, they'll say, the total of warranty claims can't be more than 10% of the purchase consideration. The buyer will say it has to be 100%, and then you end up somewhere around 40 to 20%. Usually there's a time limit for submitting claims. Again, the seller will say 6 months after completion. The buyer will say 3 years, and then you end up negotiating and ending up somewhere between 18 months and 2 years. The seller will say you can't make a claim for anything less than $50,000. sorry, the seller will probably say you can't make a claim for anything less than $500,000. The seller will say, but that's our total consideration. So we can make claims for more than $5,000. And then you end up at somewhere around 0.1 of the transaction price. And then the whole concept of bundling of claims. If you agree that you can't make a claim for anything less than $50,000, what happens if you have a bunch, if you have 10 of those of claims of $49,000 each? Are you able to bundle them or not? So that's a critical sort of area of consideration. The claim process itself, again, in the agreement, typically you'll say that the buyer has an obligation to minimize the loss. So once you've got a warranty or an indemnity, as a buyer, you can't just sit back and pay everything on the basis that the seller will ultimately bear the cost. You have to act in good faith and act reasonably and so on. And then also, how do you measure the loss and the tax effects of that loss? Again, as I said, case law generally, it has got this concept of warranty true and warranty false. In practice, if you just leave it at that, then when it comes to making a claim, you then have long arguments as to whether they're doing it correctly or not. So those are the two areas of likely dispute that I see a lot in actual transactions. And then, of course, the process sets out the notification process and how you resolve disputes and so on. And then the third main thing is to say, okay, even if I've agreed the list of warranty claims and I've got a process in place and I've got claim limits and so on, how do I make sure that the seller will actually pay up? Because once the seller has exited the business, you may never be able to trace him or her again. And even if you do and you submit a valid claim and everybody agrees it's a valid claim, how do you physically enforce payment? And as a result of that, you often put in things like escrow arrangements so that part of the purchase consideration is placed into escrow for the time period. So if you've agreed a 2-year claim limit, then for 2 years that money is tied up and is available to meet valid claims. And at the end of that second year is when the money is released, whatever remains in that account is released to the seller. So if you're going down that route, then getting the seller to agree and then putting in place actual escrow arrangements and agreeing on who pays the costs and how they're shared and how the escrow agent is able to settle a valid claim and who needs to approve and authorize and what happens to the interest are all matters that you need to discuss and debate and negotiate and advise your clients on. And I think the critical point that I want to make here, and this is something that I try and do in all of the agreements that I get involved in, is actually to understand from your client how they did the evaluation, and secondly, to articulate that in the agreements, because that then helps in resolving disputes as to what loss you suffered, and makes it much easier to say, this is how we did the valuation, this was what was untrue, and therefore this is the impact it had on this is the loss that we have. If you say nothing about it, then you're just storing up problems for the future, right? The completion accounts process as well is an important aspect, and you have to make sure that you don't double count. So as a seller, I want to make sure that they didn't account for something in the completion accounts and then make a claim again for the same point. So how you set that out, I think, is important. And it gets a little bit blurry because the buyers want the sellers to repeat their representations at closing. The seller then says, I can repeat them, but I'm not the one who produces the accounts. So I don't know what you did in the completion accounts. So how do I represent something that you yourself, that you, the buyer, has prepared? And you must find a way of squaring that circle. And then the last bit is around representations about future earnings and cash flows. Buyers will always say they want, we valued the business on the basis that it will make profits of $10 million next year. And we want the sellers to warrant that it will make $10 million. Sellers, of course, say, we can't do that. I mean, why would we want to do that? But then you end up with sneaky things like no known facts that would influence the valuation representations, which you hope will work out in practice as a buyer. As a seller, you'll resist immensely. Right, so finishing off, the last thing that I wanted to talk about was this whole sort of concept of earn-out arrangements. Very often what happens is that the buyer and the seller just can't agree on the price to be paid. Seller says, you should pay me more because this business, yes, it only made 5 million profit last year, but next year it's going to make 10 million profit. So you should pay me on the basis of 10 million profit. The buyer says, well, yeah, but I don't know whether that will happen or not. I only know that the business did make 5 million profit. So I'm going to pay you on that basis. So then some clever transaction advisor will say, well, why don't we do an earn-out? So we'll pay you on the basis of 5 million, and then if the business achieves 10 million, we'll pay you another amount that gets you close to what the seller wants, which then becomes your earn-out mechanism. And it can be great. I mean, it can also be great if the seller is remaining in the business. So very often when you have private equity funds coming into businesses with the view to growing the business, they want to incentivize management to achieve those targets. So they say to them, we will pay you as each year goes by, you'll get higher amounts depending on what you're actually able to achieve. And you have this whole concept of sort of sharing the upside when things pick up. But I think in practice, it gets really very difficult. Not least because from the buyer's perspective, once you've set out an earn-out mechanism, so for example, you say, if you achieve earnings before interest, tax, and depreciation of 10 million next year, you will get a further payment of 2 times that amount, or something like, if you only achieve 5 million EBITDA, you don't get anything. If you get anything above 5 million up to 10 million, you get twice that amount. The moment you set that, people's mind starts working, and then you start doing exactly those sorts of things to make sure that you meet that EBITDA number. So all the behaviors that I've spoken about, you stop repairing things, you stop advertising, you sell as much as you possibly can, even if it doesn't make any sense, or you're selling to somebody who may never pay, just to get that one number higher, which has a big impact on them. And you get this sort of short-term profit focus, and the synergy benefit. You get that sort of short-term profit focus. From the seller's perspective, it becomes really difficult to agree on agreeing to be paid depending on what the business achieves, if you're not running the business. So the buyer has bought your business. They come in and start putting in their own systems and processes and changing the business around. So why should you be held hostage to what the buyer has done? And you have little or no control over what happens in those circumstances. So, whilst in practice it sounds great, whilst in theory it sounds great, in practice, earn-out mechanisms can be extremely difficult to structure and end up with significant number of disputes going ahead. So let me just so last bit, if you are going to use them, make sure that you define things carefully. Make sure that you identify how accounting policies are going to be applied, but also how accounting judgments are going to be applied. Because the easiest way of manipulating profits for a given year is just to start changing your judgments. So last year you said that machines have a 10-year life, and so depreciation was 10% of the amount. Next year you decide that the life is now magically increased to 15 years, so that your depreciation charge is a lot lower. So those sorts of things you want to make sure you've incorporated into your agreements. Right. So just a list of do's and don'ts. Do specify definitions, policies, judgments. Do set out allowed and disallowed post-completion behavior, but you must have some flexibility to adapt to changing circumstances. And do adopt dispute mechanisms, resolution mechanisms that are similar to what you had in your completion accounts. Don't just give descriptive definitions like EBITDA is equal to earnings before interest, tax, depreciation, and amortization. This is true, but doesn't tell you what do you mean by earnings, for example, and doesn't tell you how you measure depreciation, for example. And then don't take the lazy way out and just say that the auditor will audit and prepare the computations, because as I said, they are able to audit things that occurred, not things that did not. And usually the bad behavior is around, either delaying things or not doing things. And yet, as I said, again, the auditor independence rules may prohibit them from acting anyway. Right. So last thoughts on this. I think just to make that point that as advisors, our focus should not just be on completing the deal and getting it done and moving on to the next one. We add value to our clients if we structure them, document the transactions, execute them in a way that our clients know and feel that we protected them, and secondly, we help them either create or preserve value beyond their completion. And if you're able to do that, I think you'll find that a lot of your clients come back to you and want to use you again, and that's how you build your business. I've certainly found that, certainly in my circumstances, a lot of my clients are repeat clients. And to me, that's a big badge of honor to say that clients want to use you again because they see that you can deliver that value. And I'm sure that all of you will be able to do that as well in your own practices. So let me stop there. Thank you very much for listening. I know it can't have been easy being on the end of a monologue of that length, but I hope that you took away something from the presentation, and I'd be very happy to answer questions as we go through the panel discussions or otherwise. Thank you.
Wow, thank you so much, Naval. That was indeed a lot to digest, but equally useful. Don't worry, I saw people asking for the slides in the questions. We will be sharing those at the end of the presentations, either through ULS sharing the presentations. Thank you so much, Naval. Before we go to any questions, we'll just receive a few thoughts on the employment angle, which Mrs. Karagaba hinted at earlier, and yourself, but just the employment considerations in the M&A process. So without further ado, I'll just turn to Mr. Moses Segar to hear his thoughts on employment, then we'll handle all the questions together. So, Mr. Sega, over to you.
Okay, thank you, Jonathan. And I must say, a very well presented position by Naval, very deep, and also from Trudy setting the stage. So my role today, just to tackle the aspects of employment law under Ugandan law. So I'm not an M&A lawyer, but I often interact with these transactions from the people's side. So without wasting any more time, Jonathan, just confirm that my slides are visible.
They're visible. You
Okay.
can go ahead.
So this is just a structure of the presentation. We're going to look at the elements as you can see them. So without wasting any more time, I like to use the first principles approach in trying to understand why things are the way they are. And Naval and Trudy may have mentioned that when a buyer sets out to buy, often the value that they are trying to put forward is usually around goodwill, assets, and the people. So a lot of the times, the value that is being transacted upon are the human resources of the business. And that's where employment law comes in. So these transactions, a lot of the time, are to do with people, because the value is usually created by people. And these people are usually employees. So when anyone sets out to get into these M&A transactions, the people question is almost top of mind, can either make or break the transaction. But going back to the first principles, the people usually are employees. And traditionally, especially at common law, since we are all lawyers, common law, the sale or transfer of any business resulted in the termination of an existing contract of employment. What that meant or means that employees in default or are usually personal relationships, such that if there is a change in the employer or the master, then there must be consent, or the employee must express their willingness to work for the next employer. So that was the default position. And a lot of the times, the employment law comes in to address this common law position, which often left employees exposed, because in such transactions, usually the buyer and seller are always trying to get more value and save more. And usually employees would be the first victim of such transactions. So therefore, the common law position was adjusted. And now we are just going to go a little bit back to England. The common law position was adjusted by what we call the TUPE. Many of you may have interacted with the TUPE, or the Transfer of Undertaking Protection of Employment Regulations, which altered the common law position and created an automatic transfer of employment during the transfer of an undertaking. This was intended to protect employees from dismissals during the transfer of the business. This position has been adopted in our own act, the Employment Act that we have today. The TUPE position, not entirely, but essentially, is reflected in section 27, where there is an obligation, or rather, the employment contracts are transferred automatically once there is a transfer of undertaking. And what does that mean? I know the technical side, Trudy and Naval have been talking about asset sale versus share sale. And these distinctions come into sharp focus. From an employment law perspective, the distinction is a little more nuanced than just between share sale and asset sale. Because as we say, the business being sold usually represents three aspects: goodwill, people, and assets. So when Naval talks about assets, he's actually talking about assets and goodwill. And in some instances, those two will include people. And yet on the other side, if it's just a share sale, you know, it's only, nothing changes, nothing transfers, just a shareholding. So therefore, because there may be a transfer of undertaking, which the Employment Act addresses, that means that where an aspect of the business is transferred, which will impact on employees, then there will be an automatic transfer of the contract. So that's the implication of our law, and it almost legislates that position. So again, I think this is important to bring out that the opposite of transfer of undertaking in the Employment Act is a transfer of employment. And in some instances, you will find that in the absence of a transfer of business or undertaking, you know, the default position would be a transfer of employment, where if no business has been transferred, it's just, you know, that would mean that employees are being transferred to another employer. That would be similar to the common law position. And in such instances, you would require employees to consent. And there is a process. They are entitled to give their consent to who is their new employer, and also to either be paid their benefits or to be those benefits to be, you know, moved to the new employer. Such benefits being leave pay, overtime, etc. So those two terms are fairly conspicuous under the law, and we've just tried to make a distinction here. So transfer of undertaking really, as I've said, represents the transfer of a trade or a business in whole or in part. And maybe it may be useful to just bring out some examples in this market to just bring this distinction home. So we have seen certain transactions like, just to illustrate the aspect of transfer of shares, which is the easier one. The transfer of shares transaction would not have much employment law implications because the employer remains the same. It's just the shareholder who changes. So as Naval told us, that one, usually the risk allocation remains with the buyer because they're getting everything. The seller doesn't have, you know, to worry about much. Everything comes as it is. The people, the assets, it is the goodwill. And so as an employment lawyer, I would not have any role in such transactions. And some of those that come to mind in this market, I think when Shell sold Vivo, that was just a change at the top. The employees remain the same. I think what another be worried, the Airtel, you know, it was the same entity, the employees, nothing changed. You know, we have a couple of those that we have seen over the years. But when we come to a transfer of undertaking, one that comes to mind, for example, the one that's been talked about when Stanchart has been my previous presenters have mentioned, Stanchart selling its retail business. That means it's selling part of its business. And that means that's not a share sale. It's just part of, their business, which will include both an element of goodwill and people. Such kind of transaction will have a drag along any employee who is associated to that part of the business or asset will automatically be dragged along that transaction. And so you can see that there it becomes a little complicated when you have these nuances coming in, when the transactions are structured in such a way that there is cherry picking. This cherry picking is the one that creates a lot of employment law issues, because many times the buyers want to only take what is valuable to them, and so they may not want to take on liability, leave liability, or employees who are not productive, etc., etc. But unfortunately, what the law does, it is saying that for as long as you have bought the business or the undertaking where there are jobs, those roles will be dragged along automatically. So even if you try to cherry pick around what you think is valuable to you and what isn't, you will unfortunately be left with a default position that the jobs connected with that aspect of the business that you are buying will automatically be transferred to you. And so, again, the rationale behind this was to ensure that the deal makers, the Navals of this world, as they are structuring these deals, they do not, the focus or the value should not impact on employee rights. Because you can imagine, without these restrictions, everyone would lay off people before the sale to make the transaction more sellable or more valuable in the eyes of the seller. Or the seller would insist that, just get me only that which I think is valuable. Now, employment law is against that train of thought, because it is saying, don't make employees part of the deal, because as we know, under employment law, you must have a reason to terminate employees. And that reason must be either justifiable, as we know, for justifiable reasons and for cause. And yes, the law allows, there's room for you to terminate for cause, but in terms of, say, the ETS, economic, technological, or structural reasons, which the law grants an employer to use in circumstances where the economics is not working. But sale of an asset, of sale of a business, is not an economic reason. I think that's very important to understand. So when these transactions are being done, they are not economic reasons for layoff. So a redundancy which happens as a result of the motivation to sell a business would amount to an unfair termination, because the underlying reason is making the transaction more viable, as opposed to the reasons which are justifiable in law. So I just wanted to make that very, very clear. I hope it's coming out that the rationale behind these section 27 part 2 is really intended to make sure that when employers are involved in selling parts of their business, they cannot try to make the transaction more viable by either one, laying off employees before the transaction, or making or transferring the employees in such a way that they are left exposed. So that's really the justification. And what happens just now, to address these points here, to emphasize, if there is a transfer of undertaking, there is no consent required, because of course it's automatic. It's automatic. Once there is a sale, the employees are transferred automatically. And then all rights and obligations are transferred to the buyer automatically. And the continuity of employment is preserved. So if you had worked for 10 years, the rights, your continuous period of employment is preserved, and the rights that are associated to it would also go on as a drag along. And the new employer will not be able to say, no, I hired you from completion date going forward, and therefore I have no business to do with your past employment. Yeah. So on the other hand, transfer of employment, which is not the focus of this discussion, but it's because it's the default, it's important to point out, does not include transfer of business. Employees may be transferred to a new employer, but they have to consent. And the payment of benefits may happen before, or those benefits may be agreed upon to be made portable into the new arrangement. Yeah. So again, just moving on to some of the things that you would need to do. The due diligence, I think Naval and Trudy talked about due diligence considerations. Some of the things that you have to do when you go into the data room, a labor law audit would entail that you review contracts, HR policies, and and some of the things you're looking out for are, how are the contracts structured? Are they open-ended? Because that would now tell the risk profile. If they are permanent and pensionable, and yet the buyer has a fixed-term contract model, that already will be a red flag that, the incompatibility between the tenures. The next thing will be, things like leave. If the seller has not been complying with the employment law obligations, employees are not taking leave has been lumped up, you should be able to have visibility over the personnel records to determine compliance. Leave, overtime practices, are they compensating for overtime, or is there a huge liability? And many times one of the risk areas is leave liability and overtime. Those are some of the things you may want to look out for. Another aspect that is important to look out for as you do due diligence in these transactions is from the aspect of workers' compensation. The risk of the liability around this is understated. A lot of employers may not have insurance, which is a legal obligation, but they may not have it. And or where they have it, they may not be reporting injuries in time or notifying the insurer in time. And then the injuries, the occupational injuries of some of the employees may not be on the books, but they will crystallize at some point. And those injuries can be quite expensive because, as you know, the Workers' Compensation Act gives up to 60 months wages for some people who are highly remunerated. That liability can be significant, especially where there is no indemnity from insurance. So those are some of the risk areas that we see that we must be mindful of. Also, one element should be what does the litigation exposure of cases in the courts, the liability associated with those cases. And yeah, just very quickly summing up what documents, I think I've mentioned these: the human resource manuals, employment contracts, independent contractors or consultants. Why do we want to look at these? Because the employers call them independent contractors because they have headcount restrictions, but in actual sense, they are employees. When you do the control test and all these things, they will effectively be employees. So you should be able to discern as to who are really employees and those who are not. And many times you'll find that what the employer is calling employees are consultants are actually employees, contingency workers or temporary workers. All those may represent a significant risk if there is recharacterization, which happens a lot, as we have seen. So as I summarize here, what do we look out for? Ensure that there is compliance with the Employment Act, compliance with the NSSF Act. The employer is making these contributions and is not liable to the penalties. We know that there is compounded interest if there's no compliance under the NSSF Act, and that compounded interest can be in the billions. We've seen employers who have run who have had penalties going into the billions, and unless there's a waiver from the MD of NSF, that can also be a significant risk. Of course, payroll taxes. Another aspect would be a pension. Pension rights, when you're doing due diligence, if the employer has pension scheme or retirement benefit scheme, what is the nature of the scheme? Is it a defined benefit, defined contribution, and is it outsourced? Is it in-house? Do they comply? Many times you find that pension liability can be significant and it can affect the pricing, because the new employer will be taking on this liability. And if it is not identified, they will end up serious, less value captured. Yeah, and of course, I have mentioned that you have to make sure that the employer has been complying with the whole universe of employment or labor laws, which includes occupational safety and health, etc. So I think I would like to end it here, so to allow for questions and answers. Thank you for listening to me. I hope I have covered the areas sufficiently. Back to you, Jonathan.
Thank you so much, Moses. I think that was useful, especially because employment law is something people usually gloss over, but I think when the rubber hits the road, that's where risks may arise and kill a transaction. There's even been litigation sometimes arising out of it. So thank you for that. Maybe just to start with you on the questions, and this is not from the chat, but just from hearing you. And I think Trudy, Mrs. Kagawa hinted on it. When two companies come together, there might be a clash of culture, people culture, the company culture, and sometimes that's even the reason why there's been a sale or a purchase. Culture issues around management, integrity, and things like that. How do you manage? Because sometimes for a buyer, I want to, for lack of a better word, get rid of the problem people who I think are a problem, and start on a clean slate, or bring in people from my organization who have been doing what I think is the right thing, or the thing that gets us to be big or good. So how do I manage that neatly? Do I get rid of the people? Do I put them on leave? Do I get into, what are they called, agreements to leave the organization? How do I manage that, especially where I say there are two CFOs, one from the existing organization, one from the organization I want to buy? I think there's a question, how do you manage the people when there's a culture issue that you want to sort out? Thank you.
Thank you, Jonathan. I think you have raised a very important question on how do you integrate if there are two entities coming together, a merger specifically. You obviously cannot have to see two organizational structures. So one of the things, and that's where now we must have a distinction, that yes, you cannot layoff on account of a business transfer. That's forbidden by the law, as we have said. But you are entitled to lay off on account of economic, technological, or structural factors. Now, if you have a structural factor where you have two organograms, you have acquired a business and it's left you with two organizational structures, and yet you can only work with one, the law allows you to restructure for organizational reasons. And that would mean that you want to integrate the two aspects into one. So that would be a legitimate reason for restructuring. And if the restructure impacts on certain roles, then that would be a legitimate termination, because the employer cannot continue with roles that have been eliminated from its structure. So yes, it's true that the law would allow you to restructure once the deal happens, and you're armed with justifiable reasons in law to lay off such employees who do not fit. That is legitimate. And maybe also to touch on the other aspect, that there are those who may not necessarily be duplicated in the new structure, but their terms, the terms are not aligned with the new employer. So even there, you may have a situation where you are able to vary the terms, vary the contract. So yes, they have been automatically transferred, but the law allows you to vary the terms. Of course, usually they say you can only vary upwards or in such a way that does not prejudice the employees. Yeah, but there is scope as to what is more valuable or what's prejudicial is subjective. But and it's important, yes, that once the merger happens, you can't run two HR policies, you can't run two sets of contracts. You'll eventually need to make variations of contracts so that they are fully integrated to the destination employer, the transferee. Yeah, I think I'll stop there.
Thank you for that. That's definitely, useful, and I guess one could dig up more on that, but that's helpful for now. I'll just move to Naval. There are, I think, 3 questions for you. Maybe you could handle all of them. I don't know if you've been able to look at them, but I'll just read them for you for your consideration. As an outsider, what is your broader view of the place of legal due diligence in a typical M&A? One has argued that maybe M&A lawyers overstate their importance. What's your frank? Because perhaps you never hear of someone walking away from a due diligence because of M&A findings. You never hear someone walking away from an M&A because of due diligence findings. So what's really the place of the M&A lawyer? I think I'm paraphrasing the question. There were 3. The second is a risk we increasingly face is post-completion integrity risks, especially from local parties. The documents are clear, but local parties often contest or flatly refuse to comply with future post-deal obligations, such as warranty claims, indemnity claims, put or call option claims. How do you factor or price this? Would you recommend that a client walks away from a deal because of what you foresee as prospective integrity or non-performance risk? And then the third one, you maybe handle all of them at once, is on the more technical point regarding price adjustment. I really struggle with working capital, and thank you for clarifying that it's not an IFRS standard issue, but a party-to-party point. Is it possible to have working capital operate as a separate variable and without completion accounts? That is, the parties agree on a fixed price in either a share sale or asset sale, and then a separate agreement, agree a minimum working capital amount that the buyer should find if the business is at a defined point X. you can figure out how to handle those in maybe the next
Okay.
next 5 or so minutes, if possible.
Sure. Well, first of all, thank you very much for the thoughtful questions, and clearly, very important aspects. I think dealing with the first one, how important is legal M&A, and in practice. I mean, as I said, I've spent 30 years of my life doing transactions, all of which have always had a lawyer and a lawyer doing due diligence. And like everything in life, I mean, there are transactions where you've really, thought that the legal team has added significant value, and then we tend to recommend and do many more transactions with them, and other transactions where you haven't felt that, and you tend not to recommend them to your clients going forward, right? But in principle, I think that the legal due diligence is extremely important, and actually they add significant value, provided that the legal team actually understands how what they're doing fits in with the larger deal structure and what their client is trying to achieve. And I think that really is the big sort of nuance that has to come across there. And if the law firm is simply doing effectively a compliance review and comes up with a list of findings and says that they don't have this permit here and they don't have that permit there, and they don't have, my favorite one was we're trying to buy a hotel, and they said they don't have an ice cream permit to sell ice cream at the business, which is true. I mean, it was certainly true that they didn't have it and they should have it. But if that's the long, sort of long list of findings that comes out, then in of itself, it's not very helpful. What is helpful is if the legal team is able to articulate and understand what is important for the transaction, and is able to bring out what they have found to buttress those particular aspects, and to work with the clients to propose workable solutions, then they become a lot more valuable. I mean, to give you an example, I mean, if you have gone into a business and you have found that, they don't have a large number of permits and so on. So then the question is, okay, so what should we do? Should we just walk away from the transaction? And usually the answer would be to say no. The right response is to ask the seller to get those permits before completion. But then beyond that, also to say, okay, even if they don't have those permits, what is it really going to do? I mean, it means that maybe you have to hire somebody for 6 months post-completion in order to work their way through and get all these permits. Fine, then factor in that cost as part of your post-integration dis-synergies, as it were, in doing your evaluation, but do the transaction, right? Conversely, your client says, the business that we have, we're looking at, they've got this, they've just put up this great big head office. It's only 50% occupied. We don't really want the business going forward. It makes no sense. So if we're going to buy it, we're going to want to transfer it or sell it immediately thereafter. A good legal team will say, will contribute to that discussion by saying, we have looked at all of these rental agreements. We think it's going to be possible for you to either sell it with vacant possession, or it's not going to be possible to sell it with vacant possession because of the way that the rental agreements are in place. So when you're factoring in the proceeds from the sale of this building, please take these factors into account. That, I think, is extremely valuable. So, the best lawyers that I worked with are the ones who are around the table with the client, with the transaction advisor, talking about commercial issues and bringing their perspective to that discussion. and are coming up with workable solutions to the problems that all three sets of people have identified. So in principle, extremely helpful, and I strongly recommend those legal teams that I've worked with that are able to provide it. I think the second question would be, this integrity risk that, yes, we can, we all designed and written beautiful agreements that have, huge number of clauses and have all the protections, put options and tag alongs and drag alongs and obligations and post completion factors and the need to act reasonably and all of that. But in practice, you find that one party just ignores all of that and refuses to do anything. I think it's a very real issue and is a discussion that we have with our clients right up front. And very often when we're doing buy-side arrangements, and particularly with international and regional businesses, they come in and say, these people have really built the business. It would be really, they've got a good standing in the community. It would be really good for continuity to have them around. So we should have them, in the business, leave them with a 20% stake, and then we'll build all of these tag-alongs and drag-alongs and exits and all of these. Very often you need to have a good commercial discussion with your client and say, if you do have these concerns around integrity and their ability to fulfill these conditions, or indeed the willingness to fulfill it, actually rethink whether it makes sense for you to have a clean break. And increasingly, I think people are coming to that conclusion that you're sometimes better off just having a clean break. And even if you were prepared to pay $20 million for 80% of the business, actually you may be better off offering them $22 million for 100% of the business, and not having to deal with all of these things, and to really force your client to say, what exactly is it that you want these people to contribute, and how important really are they to the business going forward? And even if you do lose some of the business, factor that into your dyssynergies. Therefore, don't pay $25 million for 100% of the business. Pay only 22, but you may be better off in that scenario. So I think it's an important lesson. In the early years of my career, I'd never seen a warranty claim or a dispute or of any agreements that we had ever written. And then over the past 10 or so years, you just see nothing but disputes everywhere. So in those circumstances, I think buyers are becoming a lot more savvy around saying, actually, a clean break may actually make more sense for them. So, and if it's not possible, and if the guys say there's nothing we can do, then you need to design your business plan in such a way that actually they can't do any damage to it. And that gets hard, and you may not be able to agree the price, and therefore you might need to walk away. But that's the only other way of dealing with it. I think this third question, which you talked about working capital and how that works. Maybe if I can, I had a set of more slides actually that I'd prepared, but which I chose not to present because it was getting too long and too detailed. But maybe I think I should try and present that here. Give me 1 second. So, I mean, this is the typical form of completion accounts, right? So as you said, typically you have this debt and cash free enterprise value. You have the shilling for cash items and debt items, and then you have this actual working capital and normal working capital, and the difference between the two is what adjusts the price. And And I agree with you. It is a really complicated thing that unfortunately people try and take a shortcut and they just use the terms working capital without actually defining what goes into it. And then you end up with all sorts of disputes. And there is no, as I said, no IFRS definition of working capital. So what you do actually have to do is to do things like this sort of statement, which says, which sets out the balance sheet as at a particular point in time and actually says what falls into each category. And it really depends on how the company is and what sort of things appear on its financial statements. But like in this circumstance, we said, prepaid rates for this property are part of working capital, whereas other prepayments are not, right? We said things like payables to sellers, some bits of it were part of working capital, but other elements are not, and each one was defined carefully as to what goes into it. So if you do it in this way, then you get some sort of a better understanding between the parties. And actually, I'd made this point around also making specifying the accounting policies as well as judgment matters as to how they're going to be measured carefully. So the long and short of it is, it is complicated if you want to go down the working capital route. You asked the question to say, can you do working capital just as a standalone? I think my answer to that is, okay, technically you could, particularly if you defined working capital in this way, but you have to understand what the working capital cycle of this business is. And usually a working capital cycle is sort of, on the sales side, it's sales to receivables, to cash collected. And on the payable side, it's cost of, you incur a cost of sales or expense. It goes into a payable, and then goes out as cash. But there are lots of other things that they do, like whether they are renting properties, or whether they are making lots of prepayments for down payments for things, or whether they have a lot of warranty promises that they've given to their customers, and whether they're collecting cash in advance from customers for services to be delivered. So all of those things impact what the working capital cycles are for the business. And you then have to ask the question to say, because working capital always turns into something else at some point. Either it turns into cash or reduces borrowings or something else at some point. Does it really matter whether what you receive? A lot of people, I know, people who approach the business valuation as being fixed assets plus goodwill plus value of assembled workforce, then get very fixated on the balance sheet that is delivered. But the reality is that most valuations are done on the basis of future cash flows. So what working capital actually is delivered, provided that it turns into cash relatively quickly, doesn't really matter that much. So my discussion with the client would really be to say, how are you looking at this business? How are you valuing it? And does the amount of working capital that is actually delivered really matter to you or not? And very often you'll find that it doesn't. In which case, then the sort of lockbox arrangement is fine. Where you've defined it at a particular point in time and you don't really care what is delivered. If circumstances are different, then yes, but it's very difficult to isolate working capital from the rest of the assets and liabilities. I think you'd want to do a full balance sheet anyway, and then set out what elements of that qualify as working capital and what do not. So I don't know if I've answered the question. It's a complicated one. It's and that discussion and debate with lawyers is always interesting because they come at it from with a different mindset. But that's what enriches the discussion with the client and helps them understand what the right way to go would be.
Thank you, Naval. Thank you for Naval. I think you've done a fair job. I mean, considering the time and everything. But thank you so much. I'll just move to Mrs. Karagaba. There are a couple of questions for you, but maybe I'll just lump some of them together and you could handle them together. I think one was from Mrs. Gakiza asking that what are the critical M&A considerations to have in mind, like what is a must-have in an M&A deal? I mean, in a due diligence for an M&A transaction, that was one. I'm just paraphrasing them. The other question was, where do you place intellectual property in due diligence, or is it covered under something else? I think you could cover those two because they touch on the due diligence process. And then the other is you spoke of due diligence, and most of the due diligences turn out to be comprehensive due diligences as opposed to the red flag. And so a client comes to you and says, I would like a red flag, maybe priced at $10,000, and then at the end of the process, you find yourself running a maybe $30,000 or $50,000 due diligence process. So how do you factor it in as in billing? Of course, you might be conflicted in handling that one now that you're in-house, as opposed to your prior life where you are out, outhouse. There are three. Actually, there's another, but perhaps you could see how you handle all the four. The other was the ethics of when clients come to us because they know they would like a lawyer who has experience in a matter, but then and they may ask you, what were your lessons from a previous transaction? How do you navigate the ethics of not sharing intimate details of a previous transaction while still proving your practice? I think you could speak ably on that from being both in-house and external counsel for that.
Thanks, Jonathan, and thank you all for your attendance and the questions that have been asked. And I wanted to start on that point, the point that Paul is making, that customers or clients will ask for red flag due diligence, but at the end of the day, they end up taking a lot of time, requiring a lot of commitment from external counsel. And of course, the challenge is that if you want to continue adding value to clients, if you want clients to bring you more work, it's the extent to which they go to support you. I want to give an example of what Navo was saying, why he's able to retain the clients that he's retained for a long time. Part of that is how far you're willing to go beyond the obvious to be able to address what the client requires. So it's a dilemma, it's a pricing issue. Sometimes the deals are so few and far between. If there are 5 deals in a year and you're an M&A lawyer and you have not touched one, of course, that's not a good place for you to be in. So Paul, I associate with that dilemma from my former life. But as a client now, obviously, I want to get more value, but not in a way, of course, that is extractive or oppressive. But the line isn't always clear. Also, because as you start to do the work, sometimes more issues come up than what you already have. Paul, you also talked about the ethical question. How do you demonstrate competence, experience, without saying more than you should say about prior deals? I think there's always ways that you do that, because first of all, if the transaction was in the public domain, then you don't need to be the one to say, we actually did a deal for client X and this is what happened. So if it's in the public domain, then of course sometimes the issues of disclosure become less of a concern. But also, I think in the conversation, there's always ways and means to relay an experience that you dealt with without necessarily talking about specifics. For example, it might be an issue to do with an executive, and the client might say, based on our due diligence, there's this executive that we don't want to keep. So how do we deal with that executive, considering what Moses said, that there's transfer of employment? So you might be able to say in a deal X, we did this and that without getting into the specifics of who the individual was, what their specific circumstances were, but they demonstrating that there is an experience that that you can share with the client. Coming to Emily's question on key areas in due diligence or legal due diligence, I think the starting point is essentially coming to a couple of slides that I covered. The one is when you understand what your client wants to achieve, even how you do the due diligence matters. For example, a typical scope in legal due diligence is material contracts. So if your client has told you that I want to buy this business because I am targeting a specific offtake contract with the government of Uganda, for example, how you approach the due diligence then must be able to single out what are those offtake agreements that the client is targeting, and making sure that those contracts will be able to transfer with the business. Of course, you want to check, are there any change of control restrictions that exist? Do I need to get somebody's consent for the buyer to take over this contract? Is there somebody that must be consulted? Is there a regulator that must get involved? So you want to look at material contracts, less to do with how much you're paying for that contract, but more to do with whether that contract will be able to deliver the value after the contract is done. So one could be an issue of change of control restrictions. One could be exclusivity. If the contract restricts your ability to do more with that contract, then you want to evaluate whether it makes sense to do that sort of deal. I think the other thing, Emily, so with contracts you can cover multiple components, but what is important is to have in mind whether this contract, how critical it is to the client conducting the business after the transaction, how critical it is from a valuation perspective, because it might be material, but by the time you do the due diligence, it maybe has 2 years to go. Now the client has told you, with our strategic plan, we want to do this for the long term. So you want to evaluate, okay, if it is about to expire, what is the process of renewal? Is it an onerous renewal process, or is it a process that is straightforward, so that you're able to advise the client in that regard? I think the other thing that is important, and I mean employees, Moses has talked about that, but what we usually miss is transaction-related liabilities, not just whether the person is made redundant and you need to pay, but sometimes there may be a management incentive program, particularly where the seller is a private equity firm. Usually private equity give certain incentives to their management to run the business so well up to the point that the business has to be sold. Now, you need to understand what is the scope of that management incentive program and who is going to take responsibility for that, because post-completion, you might say, I like these employees, you decide to keep them, and then inadvertently, the liability to pay out the management incentive program comes to your client, who is the buyer. And of course, by the time that employee exits, if the transaction delivers the value required, all of a sudden, the incentive, the value of that incentive is much larger. So beyond looking at, as Moses mentioned, NSSF, have you made your deductions, pay as you earn, and so on, you want to make sure, when I take over this business, when I take over these employees, is there anything extra? It could be some retention bonus arrangements which overlap the transaction. So with regard to people, that's what you want to look at, or with employees. If it comes to, when it comes to, of course, the shareholding, whether it's a sale of assets or a sale of shares, you want to satisfy yourself as to who actually owns the shares. We know in Uganda, most of the time, the share transfer forms are signed, they are never registered. So you go to the company's registry, you look and you see shareholder is Gertrude. But in fact, maybe that those shares have changed hands so many times, transfer forms have never been filed because maybe they don't want to pay stamp duty or transfer duty. So you want to trace the history of that shareholding as far back as you can go, so that every share, every fraction of share is accounted for, so that when you buy this business from X, you're comfortable that actually the person I'm buying from is the right person. Now, as Naval said, you can put a warranty and say, I warrant that I own this business and I will indemnify you if I don't. But then you come to the point that Paul was making. You don't want to go through an enforcement process, sue the sellers, assert your claim, wait for the judge to sit, make a decision. 5 years later, you're still debating whether you actually bought the shares. So you want to make sure that if it's a share deal, you trace the history. But also, if it is an asset deal, there are certain assets that are critical to a business. You're not going to concern yourself with vehicles, whether the vehicles are owned or not, may be neither here nor there. But if it's in manufacturing and there's a plant, the whole enterprise hinges on that plant. You want to make sure, was it bought by the company? Is it hired by the company? Is it on a lease by the company? If it's on the lease, what are the terms of that lease? Is there any issue with change of control? Are there problems that might come up later on? Are there lease liabilities that may hang around and ultimately come to the point where the owner withdraws your use of the plant or the equipment and the entire business falls apart? So with assets, you don't want to focus on, cars and furniture and things like that. In fact, as Naval would have mentioned, we never really think about how many chairs or laptops or whatever. We can buy those, the buyer can afford to buy furniture, they can afford to buy cars and things like that. They may not be willing to replace an important piece of equipment early on in the process. I think on contracts, I already mentioned, there are certain dimensions that you want to focus on. For example, if it's an offtake agreement, it's one contract that delivers 80% of your value. That's a contract that from a legal due diligence perspective, you want to spend time on. But it could also be related party contracts. The business might look successful, but what you're actually having is just movement from one related party to another. It looks like we are selling, but in fact we are selling to a related party. It looks like we're earning, but in fact we are earning from a related party. So you want to make sure that the due diligence covers how those relationships are constructed, in order that Naval can tell us from a valuation perspective, is there a substance in this business, or everything is just moving around among the related people. Of course, there could be other more complex arrangements. Maybe there's a revenue share arrangement. As a legal counsel, you want to find out, do they share any revenue with anybody else? Or is all the revenue coming to the shareholders? Because as a buyer, I may not be willing to share revenue, but if you don't disclose that, then of course I find myself with a challenge. But it could also be financing. I may have borrowed money from a bank, or I may have taken on an asset that has a continuous or continuing liability attached to that. So those are some of the elements that you want to pay attention to. Again, depending on the nature of the transaction, depending on why the client wants to do the transaction, considering the value of that asset to the overall business. Of course, there's an issue of licenses, and maybe, there could be, a trade license or whatever. Again, you don't spend too much time on a trade license. It's given in the normal course. As a lawyer, that's not where your real value comes in. Your real value comes in if a sector-specific license is at play. So if you're doing a due diligence, let's say
on a bank, and you want to check, do they have a valid license? Did they pay the license fee? But more importantly, what is the risk to that license? And so you want to make sure you have access to the on-site examination reports, because you want to see, is there a risk that Bank of Uganda might find that this bank is not capitalized in the next 2 years? So it's not just a matter of saying, do you have a banking license, yes or no? But it's about understanding the risk to that license. Is there a present risk to that license? And you find that out from the regulator's reports, correspondence with the regulator, and things like that. Somebody asked a question about IP rights. Now, depending on the business that is concerned, IP rights carry different weights. So if I am buying a technology business and I am targeting the innovations in that business, remember I said sometimes you want to acquire a capability. You want to make sure that your due diligence on intellectual property is not just a legal one. It's not superficial. Did you register, with URSB and so on? You want to take it down to the level of understanding if it is a patentable innovation. Was it registered as such? Is there a process to complete that process? Is there somebody else who might have a claim? You always see IP disputes. Amazon is disputing with Google. Microsoft has a dispute with this person, because when it's technology, there are borrowed components and there's always fine lines. So depending on what you're buying, you want to consider the significance of the intellectual property, or it can just be a name. If the name of that business is such an integral part that if you don't have that name, you don't have a business, then you want to step back and say, is this license still valid? Is it running? Is there a risk to that license? And so on and so forth. I want to just maybe stop on a couple of points. One is tax. Of course, tax, we all know, have they been paying their taxes and things like that. But tax can actually, tax liabilities can destroy value in a significant way. Not just tax liabilities relating to the transaction, but historical tax liabilities. So again, depending on the complexity of the tax profile, if they have excise duty, they have customs, they import things, they export things. There is, of course, numerous employees of different categories, some foreigners, some not, some non-resident, and all of that. Sometimes as a lawyer, you also need to understand your limitations, that you can advise your client that the tax profile of this business is so complex, I suggest you bring in a tax expert. Similarly, with environmental issues, it may be easy for you to say, do they have a license to do this and that? But if you're advising on a transaction, maybe it's a manufacturing plant, they release effluent, they release potentially toxic gases into the air. As a lawyer, don't just go and say, this is what the National Environment Act says, these are the rules, they have a license, therefore we move on. You want to advise your client, even if it means you're sharing the money, it is better that the transaction is successful. That way you'll be able to get more. So the point is, I guess, Emily, in summary, that for you to add value to your client is not to look at things which are obvious or things which are easy to fix. If someone says, like I said, they don't have a trade license, you can get a trade license in a couple of days. So don't advise your client to walk away because in a certain location, the trade license expired. However, if you find that there is an environmental issue, maybe there is a sanction, NEMA has written and said, within 30 days, if you don't respond, we are going to close down the factory, or we are going to remove a certain aspect of the building. That is material, and it makes your client think twice before they go ahead. Or if it's IP and you find in your due diligence there's a claim, somebody has written and said, actually, the top earning brand was stolen from me. You want to make sure your client understands. So bottom line is, it's really understanding what I want to achieve as a client, understanding what that means to me from a value perspective, how much I'm willing to pay, but also how much I'm looking to get from this transaction. So thank you. I think I've covered all the questions, Jonathan. If I've left one out, you will please let me know. Thank you.
Sure. Thank you so much, Trudy. You did cover all, but I think one more. There were two that came. Naval has handled one in the chat. He's responded. But there's one
I can't
more.
hear Jonathan.
Oh, sorry. Can you hear me now?
Yeah, we can hear you.
Okay. Yeah, there was one more that came through. Apologies for that. For which I think Trudy can handle. It relates to drafting sale and purchase agreements. At the time of defining the conditions precedent, CPs, would you recommend that the CPs are drafted in a way that they should be complied with before signing, or the SPA, or that they are met before signature and completion date? I think that's the only pending question I see.
Okay, and Naval will supplement here, but the conditions precedent are conditions that are necessary or are relevant or essential for you to be able to complete the transaction that you want to do. If I give the example, you want to buy a bank, you want to make sure that you articulate what is required for you to buy the bank or to sell a bank. For example, a condition precedent could be you need shareholder approval, you need board approval, but more importantly, you need central bank approval. Now, you want to make sure that you lock in the conditions precedent. Otherwise, as Naval says, you might end up in a dance as to whether you have done the part that you are supposed to have done. And so usually then, or typically, you want to lock in the conditions in the SPA, you sign it off, and then the parties get to work to complete their respective obligations. Sometimes, of course, depending on internal matters, it might be that in my company, the board says never sign an agreement until the board has approved the transaction. That can be a unique situation, but usually you will sign the share purchase agreement with all the conditions precedent in there, so that when the parties apply themselves, sometimes you need to spend money. For example, if you're getting the COMESA Competition Commission approval, you need to pay an amount of money, $100,000, $200,000. Parties should not go to an expense if they're not sure that there is an intent to complete the transaction. Similarly, if you were to go and get regulatory approval, you want to go to the regulator and say, this is the deal that we've accepted, but we recognize that it is subject to approval. Read through, this is what we want to do, and let us know if you're comfortable. So it would be an unusual situation where you agree, you couldn't even say you've agreed on the CPs, because until you sign, everything is up in the air. But once you commit to the deal, you put it down in writing, you sign it off, and then all the parties go to work. And then, of course, you continue to evaluate. I think Naval should have mentioned, sometimes, depending on the business, you may have transition or pre-completion activities that you want to do. For example, if it is about a non-core asset, you say, I don't want to buy that piece of land. So you might say, the moment we sign, start the process of selling that land, and we will only complete when the land is completed. So you don't want to get to work, write to regulators, start spending money before you've agreed the conditions. But also, the regulator will want to see that they're dealing with a firmed up transaction, not something that might change, and therefore the regulator will also require that. But maybe, Naval, you want to just add to that? Yeah, I would not see a situation where you can start working on CPs until you sign something.
Yeah, it would be highly unusual to request the seller to start doing things to their business, unless it's something that they were going to do anyway, right?
Yeah.
It's good for their business, but it's not at your request necessarily. But if you're requesting the sellers to do things, then usually those would only be CPs after you've signed a binding agreement. Otherwise it becomes, I would never recommend to a seller to accept to start changing your business on the basis that while you're still negotiating something. So that would be my perspective.
Okay. Okay, thank you so much, Trudy. Thank you so much, Naval. Thank you so much, Moses, and ULS for organizing this. I think it's been useful. It's been helpful. Thank you so much, everyone. And I think we're almost about time. We're almost about done, and our time is spent. So unless there's any further input from the ULS team, I will call this meeting to a close. I don't know, Ruth or Doreen have anything else? If not, thank you. We will be sharing by email. The ULS tells me that we'll be sharing the recording as well as the slides by email for those who participated. Yes. Otherwise, thank you, everyone.
Thank you.
Bye-bye.
Thank you, Jonathan, for hosting. Thank you, Naval, Moses. Have a good afternoon, everyone. Bye.
Bye. Bye, everyone.